The first speaker this morning is Brad Powell. He's coming to us from the west coast of the United States.
My screen would have a picture of me up there and something that says right angle trading. Okay, great. Good morning, everybody. Thank you for coming. I'd like to thank the organizers of this event, Value Charts, Metastock, everybody for having me back. I've done one of these before. These are great day-long events that you can kind of pop in and out of, or view all the sessions, or one or two that may interest you. And as I always say at webinars, it's really great to always see what other people are doing in the markets, and hopefully we can all learn from each other and see what other people are doing. What I do in the markets may not necessarily be right for you. What you do maybe not right for me as far as a trader, but there's still a lot we can all learn from one another. So I want to thank everybody for coming. So I'm here today to talk about ETFs. Right Angle Trading was a company that we kind of really embraced the ETF market, especially the leveraged ETF market, beginning in about 2008 when the SEC passed new regulations allowing active management of ETFs, meaning highly leveraged ETFs, that people could manage it through options and a variety of derivatives in order to gain leverage in these ETFs. So that's what we're going to talk about today. But one of the most important aspects of ETF trading, because they are a little different, they have their own idiosyncrasies. They don't necessarily trade exactly the way a stock would, and certainly not the way the unleveraged ETFs would, such as the SPY for the S&P 500, what were used to be called spiders, and are just tracking stocks for the index that really are going to track to the penny the percentage move of the underlying index during the day. And at the end of the day, the price is going to be adjusted by the market makers to make sure that it's exactly at the same percentage gain or loss as the underlying index. That isn't the case with leveraged ETFs. And because that isn't the case, you need to be aware of some of the differences regarding them if you're going to trade ETFs. And our contention is risk management starts before you ever place the trade. So let's look at some of the ways that that line kind of comes true and some important aspects of ETFs that you should be aware of. Now, for those of you who don't know, an ETF is just a tracking stock with a variety of leverage for different sectors, commodities. They currently represent 45% of daily market volume, which is a staggering figure when you think of that. And there's over 1,400 different ETFs currently trading today. But when you enter a trade, regardless of what methodology you're using to take that trade, there are some universal things about ETFs as related to risk management that you should be aware of, or that I believe you should be aware of. And I'm going to show you some tricks that we use for kind of setting that. We all know part of our risk management is where is our stop going? How are we going to trail a position if it's moving our direction? I'll look at some specific technical indicators we use and show you how to set them up to kind of help us manage the trade after we're in it. But let's start with the basics. The first important factor of risk management in an ETF is the leverage selected for the trade. So most markets offer an unleveraged ETF, such as the SPY for the S&P 500, the DIA for the Dow Jones Industrial Average, that are perfectly going to track the underlying sector, commodity, etc. Whatever it is, the bond, the currency, whatever it is that ETF represents. A double leveraged ETF, which will return twice the daily investment return that corresponds to the underlying index, sector, commodity, etc., is available for virtually all markets now. There are inverse ETFs, unleveraged and double leveraged. An inverse ETF means it's a bear ETF, so it's going to go up when the underlying index or market goes down, allowing you short exposure in an IRA, 401k. Sometimes, if you have a retirement account that doesn't typically allow you to short sale, the inverse ETF allows you to go long and get the inverse return of the underlying market. And some markets offer triple leveraged ETF and triple leveraged inverse ETF, so they're going to return or attempt to return 3 times the daily investment return of the underlying index sector or commodity. There have been some experiments with even more highly leveraged ETFs, and to date, I think the majority of those have failed. The one that sticks out to me was called the RTSA, which was basically trading with about 6 times the leverage of the Russell 2000, and it was a bear ETF. And this is during a bull market, and they introduced a bear ETF at about $100 a share, and it went to zero very quickly in a matter of months at 6 times leverage. And I believe it was Barclays that introduced it. They ended up just doing away with it. There wasn't much interest in it. Traded very little volume. So as an investor, and excuse me, I'm periodically sipping my coffee. So as an investor, as a trader, you need to be aware of what leverage is available to you and understand that compared to buying the SPY for the S&P 500, if you were to purchase the UPRO, the triple leverage bull ETF for that same market, you're going to have 3 times the risk when you enter the trade, although you also have 3 times, or theoretically have 3 times the potential reward. So always be aware of the leverage that you're trading, the leverage that's available for a different market, and the first decision you have to make is what level of leverage am I comfortable with trading. If you're day trading, you're probably going to want triple leverage, but if you're holding overnight or over a longer period of time, you may want to scale back to double leverage ETF. So that's something to take in consideration. Another important factor is the volatility of the market, and the reason that is leveraged ETFs, especially when you get into double and triple leveraged ETFs in highly volatile markets, go through periods where they're going to be even more volatile than the 3-time return of the index. And that's because most of them are getting leveraged through options on the stocks that make up the index. In the case of something like gold, they're actually in gold bonds. But early in their cycle of things like those bonds. Hey, Hal. One of our clients is here, Hal Holbrook. Good to see you. Hal, there is a wonderful list of ETFs, defines what they are and the leverage at the ETF Stock Encyclopedia. So you can just go to Google, search ETF Stock Encyclopedia, and there's a full list. And Z, I'll go ahead and answer this question now. Do all ETFs have options on them? Yes, but you have to be careful trading, especially the triple leveraged ETFs, the options on them, because they don't trade much volume. They have a wide spread. And so you're putting option premium on top of something that's already triple leveraged through options premium. So you're really putting options premium on options premium. So you can get wiped out pretty fast, or you can make huge gains on the options. The problem typically becomes liquidity of the options on the triple leveraged ETFs, because not a lot of people are buying them. They're primarily going to be used, for selling covered calls. I think is the way a lot of people use them. So anyway, back to the volatility of the market you're trading. When you're talking about triple leveraged ETFs, they may go 4% or 5% versus the underlying market if it's a highly volatile market in a given day, especially if they're early in the cycle of when they've purchased or made their decisions of what derivatives to make, because the premiums are still high on the options they may be using. So a pretty simple way to do that, is put up a percentage-based chart and look at a couple of markets to decide which one you're going to trade. Let's look at a comparison of gold and silver. So the GLD is the unleveraged ETF that tracks the price of gold. The SLV is an unleveraged ETF that tracks the price of silver. So we're not talking yet about trading a leveraged ETF. Let's just see how volatility compares between these two markets. You can look at a move up last August in silver and also in gold. And seasonally speaking, they usually do have a move up that period of time. And the silver ETF made a move up of 38. They were kind of down at that point in the year. I think I had based this over a 2-year period. So they were down at that part of the year. But as far as this specific move up, silver moves up 15%, whereas gold only moves up about 8%. So that one move, and if you look at how strong the move up is in silver, kind of tells you that between the two indexes, or sorry, between the two commodities, that silver is going to be more volatile than gold. Over this prolonged move back down, going to the exact same date at the end of the year, silver declined the SLV 15% as compared to about 10% in gold. And then over the next few months, they basically traded equally. But generally speaking, silver is going to be a much more volatile market than gold day in and day out. And when you move into something like the AGQ, which is the double leveraged silver ETF, if silver is going to have a volatile move that it may move 3% in a day, the double leveraged ETF should move 6% in a day. That's not always the case. AGQ could end up moving 8, 9, 10% over that same period, over that one day, out of correlation to silver because of the derivatives being used, the high premium on those derivatives to gain the leverage, and also simple open supply and demand in the market. So that's something to take in consideration when you're talking about risk management with the ETFs you're going to trade. And we'll compare just two U.S. equity index. If you compare the SPY, which is the unleveraged ETF tracking stock for the S&P 500, to the IWM, which is the Russell 2000, I've just marked a couple of points, and you can see that in any short-term move, 2-week move, you know, the Russell 2000 is going to move potentially another 2 or 3% farther than the S&P 500. You know, if you look from their lows to the highs on this move, you're looking at almost 10% difference in that move over a 2 to 3 month period. So that means when you move into a triple leveraged ETF, you're talking about a difference of 30% in the return. So the volatility helps you on the return, but when you catch these moves down, you have to remember that something like the Russell 2000 is going to move down much farther than the S&P 500 the vast majority of the time, because it's an inherently more volatile market. And so this is an important, very important factor to take into consideration before you ever enter a position in an ETF. Something else you wanted to take into consideration, especially from a trader's perspective, if you're looking for short-term trades in an ETF versus a long-term investment, and I'll talk a little about that in a second, but is the potential for overnight gaps. So let's look at the FXI daily. And the FXI is a China ETF. It's the large cap index of the Hong Kong index, and it's called the China 25. So it's essentially the equivalent of our Dow Jones Industrial Average, the largest 25 stocks that trade on the Hong Kong exchange. And we're looking at a daily chart on the FXI. So if you believe the Hong Kong market over the next 10 years is going to you know, show a strong economy, the market's going to perform well, it's a wonderful way to take a long-term investment. I just want to comment, this is really one of the great things about the ETF market today, is virtually any world market, any currency pair, any commodity that's being traded, anything that's being traded, there's probably an ETF for it now. And 10 years ago, it was difficult for the small investor, the average investor like us, to take a position in an overseas market. We'd have to go into an overseas fund of some kind that charged very high management fees, so it was expensive and costly to us. And if they underperformed, then we weren't getting the kind of return we wanted. Now you can log into your brokerage, buy something like the FXI, have an investment exposure to an overseas market for the same cost as buying a couple of shares of Apple or Google. You know, commissions are the exact same as they are on all stocks on most brokerages. The only real difference is they may not allow on leveraged ETFs the same amount of margin that you would normally use on a stock or on something like the SPY. But so looking at the FXI daily, what you're up against as a trader with something like the FXI is these huge overnight gaps that are caused by a simple reason. The Hong Kong market is open while our markets are closed. So you're going to wake up in the morning and see a huge gap based on what the Hong Kong market has done overnight. Now, the problem with that is if the trade goes against you, you have no control over that gap. And as you can see, it could gap away from you or against you for several days, which means you have to take into consideration how large those morning gaps can be so that you have active control of your stop the next day and know that your stop is going to have to be placed outside the range of these gaps. The other thing to consider if you're trying to actively trade these is something that I just don't like doing. Now you have to keep track of what days that market's going to be closed. What days is the Hong Kong index going to be closed for holidays that we don't necessarily have here, since they are going to have a different holiday schedule. And while our markets are closed for certain holidays, such as the 4th of July, the FXI is going to be actively trading. So you look at the size of the gap here in November on 2 consecutive days. If our markets were closed that day, you could wake up if you had been short there and see just this enormous gap that's gone against you. So that's something to be aware of, especially with overseas ETFs, commodity ETFs that are, the commodity is actively trading several hours before the U.S. equity indexes open. Volatile markets such as oil and silver can have most of their daily price movement in their futures in the 2 hours prior. That's really prime trading for those markets in the 2 hours prior to the U.S. equity indexes open. So that's something to be aware of, is the gap potential in commodities as well. Let's look at the EDC daily. So this is something that we trade. We're going to trade right now. We're short the emerging markets that we got a nice pop out of yesterday. The EDZ, which is the inverse triple leverage ETF of the EDC. And by we, I mean our various alert services at Right Angle Trading. The EDC is a broad range of smaller markets around the world, and also some emerging markets, some larger markets as well. The largest single holding of the emerging markets is Samsung out of Korea. So there are some big names in it, but it also comprises many Brazilian stocks, some of the Brazilian markets and different South American markets that are trading at the same time as the U.S. equity indexes. So we find this to be a very attractive market to trade for exposure in overseas markets because it's kind of a broader basket. Now, it still has, as you can see, some very large opening gaps it can have. This is a triple leveraged ETF. So, you know, we kind of have rules of thumb about it from a day trader's perspective. If it has an overnight gap of more than 4% in the EDC, which again is a triple leveraged ETF, I'm just going to leave it alone for the day because chances are there's not going to be that much trading range left in it during the day. If it has a 7% move on a day, 7 or 8%, I've seen it have 12% moves in a day. You can see some of those in the huge green candle early on, or in this enormous gap. What is that, 28 gapping up and down to almost 25, $3 gap in a $25 stock. You're talking about a 12% gap. On those kinds of days where it has these extreme moves, we just kind of leave it alone and won't take signal off of it because so much of that move is already priced in. And when it gets volatile, something like the emerging markets, they tend to stay volatile for a couple of days. So it's important to know that about it. Lee, I believe the sessions are being recorded. We'll have to ask when I'm done. Unfortunately, I don't know. The next area that you definitely want to look at before trading, especially short-term trading, any ETF, is the liquidity of the ETF. And you know what? New ETFs are introduced all the time, and they come and they go. Some stick, some don't. We personally like to see an ETF trade for 6 months to a year before we really want to consider trading it. There's a number of reasons for that in leveraged ETFs. The vast majority of leveraged ETFs, when they're introduced, do a horrible job of tracking their underlying market. And that's because the people managing the derivatives, the investment in derivatives of these leveraged ETFs, it takes them a few months to kind of find where they need to be, how to properly hedge to get that proper return. My rule of thumb is if it hasn't been traded for over 6 months, where I can really look at the data on it and how well it's tracking, and see how liquid it's going to be, I don't really want anything to do with that ETF. An example is the double agriculture ETF, the DBA, which if you want an investment, if you in the agriculture markets, is a good way to do it. I will say the problem with it is look at the difference in volume. So this is just simple straight volume down here. When I look at something as a trader and I see something jump up to 2.5 million one day from a prior day when it only traded about 300,000 shares, I see the potential to get stuck, to get wide spreads, where I may incur more slippage than I'm used to or more slippage than I'd like. So I always put volume up on something before I'm going to trade it. And in general, agriculture is seasonal. So as we hit late winter, early spring, you can see the move that started in the DBA, and the volume came back into it. It's more consistent. So for the next few months, there will be a lot of news related to agriculture as weather reports are looked at, how bad is hurricane season going to be, what are rain pattern predictions, are we in a drought? As we saw a couple of summers ago, the price of corn spiked up because we were in a drought. The DBA just went ballistic. But as soon as summer was over, the volume went back to this inconsistent lower volume days, and so that's something you need to be aware of. And you compare it to something like the SPY that, yes, has an occasional low volume day, and low volume for the SPY might be 25 million shares. SPY virtually always has a 1 or 2 cent spread, even at $165 a share. It'll trade 300 million on a good day, 400 million shares on an extreme day, but it always has plenty of liquidity to get in and out of without having to worry about things like additional slippage because of a wide spread, or just not enough on the bid or ask to handle your order, even if it's a small order. Another important thing to look at, and in answer to your question is supposed to, yes, I'm going to get to that in just a minute. How the ETF tracks the underlying index. I have used this for years, this example. You should always, just before you're going to trade something, put a chart of it up against the underlying index. I like to use a percentage chart to make sure that it's properly tracking the underlying index the way it should. Natural gas futures is several years ago, and I just have never found an example that could compare to this. Had a 30% rise. At that same time, the UNG, natural gas bull ETF, had a 10% decline. How can that be? Because of the derivatives they were in were so far, so far out of the money and so far out time-wise that they paid this huge premium that was just decaying, even though the price of natural gas went up. And then as natural gas flatlined, the UNG continued to decline and lost about 70% of its value, while natural gas was actually up for the year. So they completely revamped the UNG. It does an exceptional job now of tracking the natural gas ETF. But if you were considering an investment right here in natural gas and thought about the UNG, all you really had to do was put a chart up of it over the last year on a percentage basis, and you'd be able to see, you know what, it just doesn't do a very good job of tracking the underlying index. That means that my risk as an investor, as a trader, is going to be greatly increased if I take a position in that. And then the final point, and this is just one of the most important things to be aware of when you're trading leveraged ETFs, is your time in the trade versus the derivative decay. So the derivative that's being used to gain leverage in an ETF is going to decay at some point, and you need to be aware of that. The longer you're in the trade, the more it's going to decay. So here's some kind of basic rules of thumb. Most of the time, if the trade goes in your direction, leverage will work with you in the short term. If the trade goes in your direction, leverage will work against you in the long term. And then almost all the time, it is all the time, but in the market you never say all the time, right? Because as soon as you say all the time something will prove you wrong. It's like saying, the market always goes up on Christmas Eve, and if you believe that, yeah, I don't know if that's even a saying. I'm just using this as an example. If you believe that, sure enough, when you take a trade in, it's going to go down that day, right? So I just have to say almost all of the time. If the trade goes against you, leverage will work against you in the short term. And if the trade goes against you, leverage will work against you in the long term. And what I mean by working against you is your decline, I'm going to show you an example, your decline is going to be greater than what you expect it to be. So let's look at leverage working with us over a 2-week short-term move. And you can look at a simple move in the IWM, unleveraged ETF for the Russell 2000, and in this amount of time, the IWM moved 6%. So you would expect the triple leverage ETF to return 18%, but the TNA over the same amount of time, it's 2-week short-term move, actually returned 20%, so 2% more than it should have on triple leverage. So why is this, and why is that working in my advantage? If I had taken that trade in the TNA instead of buying 3 times as much IWM, why is this working in my advantage? Well, because of supply and demand in the open market. One reason that when you're in a bull move like that, a lot of people want to get into the triple leverage ETF. But also because the derivatives they're using on a daily basis to establish that net asset value at the end of the day, those derivatives are actually maybe gaining more premium during a strong move like this. So the TNA, what they own to create the TNA is actually returning more than the 3 times it should. They may reduce, because of such a strong move, the amount of hedging that's going on within the TNA to try to keep it at that 3% return. And people just want in, they just want to get in for this move. So the end result is that's the case of in the short term, the leverage is going to work to your advantage. I actually realized this late last night. I didn't bother to change it. This should actually say March 25th, 2014. Let's look at how it's not going to really work to your advantage in the long term. From November 1st, 2013 to March 25th, 2014, the SPY returned 6.75%. 3 times return should be 20.25%. So if instead of the SPY, you decided to purchase the UPRO, a triple leveraged ETF, you'd expect 20.5%. UPRO only returned 19.17%. And yet, you had the same initial risk. You had balanced risk when you entered that trade. So your return isn't necessarily going to equate to what the underlying index is, which is going to throw off your risk-to-reward ratio as you enter the trade over a longer period of time as a longer-term investment. The prior year, I know the UPRO returned actually 20% less than it should have, and that's because of the continual decay in the leverages, and because people look at these short-term trading instruments, so they're getting in and out. It's just never going to match up. And if you even look at the wording on the UPRO in their description, they say seeks to return 3 times the daily return. They're very specific about that. They don't say the weekly return, the monthly return, or the annual return. They say seeks to return 3 times the daily return of the S&P 500. So that's an important thing to be aware of. So if you're going to hold one of these leveraged ETFs for a long period of time, meaning months or into years, you're never going to get the kind of return you expect, but you are going to get have the same amount of initial risk. Now, let's talk for a second about a bear ETF or a trade that's going to go against you. And this could happen to a bull ETF as well. It seems to be a little more pronounced in bear ETFs. And this is why I said earlier, if the trade goes against you in the short or long term, the leverage is always going to work to your disadvantage, or almost always. January 3rd, 2014 to March 25th, 2014. So this is very recent. The IWM had a 2.73% return. Let's say you thought the market was going to correct during that period of time, and you wanted to be in an inverse bear ETF, short ETF. So you bought the TZA. You'd expect an 8.19% loss. Sorry about that. However, the TZA over that period of time was down 13.3%. So that's a pretty simple demonstration of what can happen over a long period of time if the trade is going against you. The same thing can happen if the trade is going against you in a short period of time. You're going to have much greater risk than you would if the trade was going, than if you were in an unleveraged ETF, because now the decay in that derivative is working against, or the derivatives they're using to gain the leverage is working against them, and that can be pretty severe, as well as nobody wants to own the TZA in the open market, so you're looking at a much bigger loss when you compare it to the underlying index than that 3 times that it should be. So those are some kind of important criteria. So I'm going to get into some specifics because, so we've kind of examined, these are some things you need to know about the ETF market that are going to help you determine, whether it's too risky, something's too risky for you to trade, or whether it meets your criteria for risk to reward, and kind of a general way to assess that. So once you've decided on the instruments you're going to trade, there are some specific tools that we use to determine a few very simple things. When are you going to enter a trade? Where is kind of the best place to enter a trade, especially in some of these, especially in some of the leveraged ETFs? Where's the best place to get out of it? Because we like to get into a trade, stay in for 2 or 3 weeks. For longer term trades, shorter term trades for a couple of days. We also day trade ETFs. Where are you going to get out so that decay and leverage never works against you? So, these are all important factors to be aware of. So I'm going to show you some tools we like to use, and I'm going to tell you exactly what they are. So the yellow indicator, I've put nice bright colors on here, so hopefully they show up in the GoToWebinar panel. What's the difference between the USO? I'm going to answer a couple of questions real quick. What is the difference between the USO and the UCO? Sandy, the USO is unleveraged oil index, and the UCO is double leveraged. So the UCO is a highly volatile ETF. It's a wonderful ETF for trading. I don't like to hold it overnight. I've day traded it. It's double leveraged on oil, but because oil can move so far so fast, it trades more like it has 3 or 4 times the leverage of the underlying index. So it does have very high potential reward. You also have to be aware of the risk going in. But so it's basically just that the UCO is double leveraged the price of oil, or the daily move of oil. So the indicators that I have on here are a Bollinger Band, just at the standard out-of-the-box settings. The green, that's the yellow. The green indicator is 20-period EMA, which is an indicator that we love at Right Angle Trading to look for kind of key pivots within a trend. And then the purple line is the Keltner channel, but I've made a change to this Keltner. We make a change to it. And in TradeStation, it's called the number of ATRs. It's different things in different charting platforms. But there's usually a setting there that default is at 1.25 or 1.5. When you first put a Keltner channel on, you'll see a couple of settings. One is for the midline, the period, which should normally be at 20. The midline of the Keltner is basically a simple moving average, and it kind of defaults at 20, which is fine because we're using a 20 EMA. I don't even have the midline on here. But whatever that other setting is that comes out of the box at 1.5, or in some charting platforms 1.25, change that to 2.5 for leveraged ETFs. And what you'll see here is, we're looking at methods to determine what is our implied trading range going to be over the short term, over the next 2 to 3 weeks. And that's why I'm kind of doing a comparison here. I want to know in a leveraged ETF, because I don't really want to be in it for longer than 2 or 3 weeks, because I don't want the leverage to start decaying to where I'm not getting the return I wanted versus the initial risk. Can I put, yeah, let me put these in the chat window. Hang on a sec. All right. Let's send it to entire audience. So now it's called different things in different things in different charting platforms. in TradeStation. It's called the number of ATRs, which should be set at 2.5. ATR is 2.5 normally, defaults at 1.5, and then the periods at 20, and no offset. If I could spell. It's too early in the morning for me to spell. Sorry about that. In Los Angeles, anyway. So we're looking for something that's going to kind of define the implied trading range, or what the trading range could be. And the reason we like this 2.5 Keltner over the Bollingers, I'm going to show you real quick, is very rarely does it stay. This is the SSO daily chart. It's the double leverage ETF for the S&P 500, and I used it to select one that isn't quite as extreme as triple leverage. But we'll look at a couple of examples of this as we go. Very rarely does it stay outside that 2.5 Keltner channel setting for more than a couple of days before it comes back in. And every time it comes back in, it either comes down to the 20 EMA to test support, or to the lower range of the Keltner channel. And it happens here. You can see it goes outside for a couple of days, comes back into the 20 EMA, comes back up, always stays inside that 2.5, breaks out for just a couple of days. Anytime it breaks out of that Keltner, you can expect it's going to come back to the 20-period EMA and test it as support. Here, it never made it back up to the top, and it broke down. This, incidentally, when you see the Bollinger Band, you can read about it. I know a couple of people have different names for it, but it's called a BB squeeze, when the Bollinger Band becomes pinched inside the Keltner channel, and it's kind of indicative that you're in a choppy period, and that also a pending very large move may be pending. And you can see there's a big move down. When this big move down occurred, it never stayed outside that 2.5 for more than a day or two. Runs back up to the top. You can see how in a strong bull market, it's just grinding along the top. So this is an indicator that we really like to kind of define what we expect the trading range to be for any ETF we're in. So let's look at it now without the 20-period EMA, so you can just see what a good job this 2.5 Keltner does of kind of telling you, you know, this move is almost over. We're going to get some type of retracement anytime it gets outside there. This is a method we use for looking at support and resistance. And I just want to say, you know, people love to use Fibonacci. Betty, who founded Right Angle Trading, huge believer in Fibonacci retracement levels, trades off them all the time, you know, on the indexes. You know, some people use floor trader pivots. That's a method that I've always liked, or your basic floor trader pivots. But when it comes to leveraged ETFs, these are indicators that don't really work. And very simply, I'll tell you why. As we saw in that short-term move, the TNA overperformed the underlying index. So if you were looking at a move and expecting a 50% Fibonacci retracement, and remember also the numbers we looked at with the TZA, and how steep its decline was versus what it should have been, the loss that it had over a very short period of time versus the underlying index, if you took the inverse of 3 times the underlying index. So if you're expecting a 50% Fibonacci retracement in an index, there's no correlation to a leveraged ETF for that 50% retracement, because that retracement may be 60%, or maybe 65%, or maybe 70%, or maybe 55%, depending where it is on its cycle of leverage and how well hedged they are at the time, because it may overshoot the move. So you can't, on an SSO chart, put up a 50% retracement level, or on a UPRO chart, which is a triple leveraged ETF for the S&P 500, 50% retracement level, and expect it to obey that. It may obey it in the index, but there's too many other factors that are weighing into the price of a leveraged ETF that aren't going to work for it. So we try to look for more adaptive methods of showing where an area of support and resistance should be. And I hope that made sense. I hope that I explained that well. I hope that made sense to everybody. We try to use more adaptive methods using exponential moving averages to find areas of support and resistance, especially during a strong directional move. And so here are three that I like to use. Green is 20, blue is 50, and red is 150. And so let's just make up a really simple trading strategy. If you purchase this ETF, anytime it got in between the 20-period EMA and the 50-period EMA, and you stop at the 150-period EMA, you would have done pretty well over this year, right? It never went below the 150 EMA. Only here did it just poke, and it never closed below it. So you'd have to use leave a little bit of room there for your stop. Every time we had a retracement, it came down kind of into this area in between the 20-period and 50-period EMAs, except for here when it came almost down to the 150. And when it hit these strong short-term moves, like this is a 2-month move we're looking at up here, it really used the 20 EMA as a support off these bounces, so an area to jump in and take a short-term move. And if that ever broke, then the 50-period EMA, you can see became an area of support. So these EMAs are very adaptive. Yeah, and I'll put them in the chat again. So it's 20, 50, and 150. So there's the three EMAs. So these are adaptive and give us kind of a point that we can look at and say, this is an area where I want to take a trade if our indicators, which we're using a combination of momentum and trend indicators to look for divergences, primarily in our strategies, but we want to see an area of support and resistance, so we're using that 2.5 Keltner channel to look for a place to take an exit, and we're using this 20-period and 50-period and 150-period EMAs to kind of help us with stop assessment and also look for areas of support. So I'm going to look at some specific trade examples, and I'm not going to show all winning trades. I'll just quickly change this over to the TNA, which is the triple leverage Russell 2000 bull ETF, and again, so let's go to a different market, a more volatile market than the double leveraged SSO. You can see how, again, it primarily used these same three areas. Once or twice it didn't, but you can see that most price pivots in this trend happen again right around that 50. Right here was a little odd or choppy. It never really, only once did it go below the 150 over this long period of time. And I wish I had left just the upper band of the Keltner on. You'd see that it's almost just right in the upper band of that 2.5 Keltner channel at every point here. So you can see that it's kind of universal and works across a variety of markets. And let's look at it on even a shorter term, a 60-minute TNA chart. Look at these. So if you're short-term trading off a 60-minute chart, look at where these price pivots are occurring in this multi-day trend. All of them are occurring right around the 20-period EMA. It comes down and breaks the 20 here, so it kind of broke the trend here, came down, never quite made it to the 150. Here you can see again an area of congestion in between the 20 and 50. We're always using this 150. Only here for a couple of hours did it really break below, which could be indicative of a trend change. As it reversed back up, again, it's starting to use that 20 and 50 again as areas of support. Price pivots on this move down. Again, where are they occurring? Right at that 50-period EMA. So the 20, 50, 150, and virtually any time frame in any market you put it on is kind of a good method, and you'll become intuitive with it. The longer you watch it, the more you'll be able to see. Yes, just Rod, I would say this works on any leveraged ETF, and again, we kind of believe in taking the trades off the tradable itself, not necessarily off the index, and applying them to the triple leverage ETF. The reason being is, as I talked about, as we've seen numerous examples of, they trade differently than the underlying index because of supply, supply and demand in the open market, because of derivative decay. So we like to chart the actual ETF that we're trading. So we like to chart the triple leverage. So I'm going to look at a couple of trades, and I'm not only going to show, I'm going to show you a losing trade after. I'm going to look at a winning trade first, and then we're going to look at a losing trade. And these are fairly recent. This was in February of this year. And how now am I using these tools to assess my stop, my initial stop, and my trailing stop? So this is a trade we had from daily charts for the TNA, Triple Leverage Russell 2000 ETF, and we got a signal, a divergent signal to go long right here on this green candle in February. It was either February 5th or 6th. And so how am I going to use these indicators? So here we have the Keltner back on at a 2.5. We have the 20-period EMA, the 150 in red, and the 50-period EMA in blue. How am I going to use these indicators to assess stop levels? My true risk management now that all other decisions have been made, I'm taking the trade, I know what I'm trading, how am I going to use these? So because when we get this trade signal, we're right down around the 150 EMA, and we're outside the Keltner channel, that 2.5 setting, we were outside of it for a couple of days. I know that we are probably going to bounce. This is what we saw in those charts we looked at a minute ago. We're probably going to bounce to at least the 20-period EMA. The minimum of this bounce move should be to the 20-period EMA. So I can just use the most recent price pivot, slightly below it, as my initial stop, and enter the trade with relatively decent stop. Once for a triple leverage ETF, once that trade is moving in our direction, has created a little space between that 2.5 outer band of the Keltner channel, has gotten a little space above the 150 EMA. In one day, we're quickly going to move that stop up to just a little bit under the 150 period EMA. Just a little bit of room to protect against a poke. But now that it's gotten back up in there and moving our direction, very quickly the next day, move that stop up. Now I can use that 150 EMA. So as the trade continues in our direction over the next 2 days, as soon as it touches that 20-period EMA, because that's the minimum I expected. When I entered this trade, as I said, the minimum I expect this bounce to be, because it's been outside that 2.5 Keltner and it's stayed above this 150-period EMA, the minimum bounce I expect is to the 20-period EMA, which is the green indicator. So as soon as it moves up towards that, I can get my stop to at least break even. So we've only been in the trade 2 days, and on the third day, I'm putting my stop at break even. So I want to keep some room. Now, so it may roll over here, right? We're coming into that period between the 20 and 50 if we're going to have a strong downtrend. Sure enough, the next day it rolled over, and then we got the huge buys came in and took us up and over the 20 and the 50-period EMA. So I'm moving my stop now just under that day's low, still a little bit below the 20 and 50, giving it a little room to breathe. Next day keeps going our direction. Next day gaps up. Now we're kind of into this mid area here, halfway between the 20-period and the 2.5 EMA. And I always expect a little chop and resistance there, and that's what we got for 3 days, because that's actually right about where the standard 1.5 Keltner channel setting would be. So I'm going to move my stop up now. When I see this congestion, it may roll over here, but it shouldn't really go below the 20 and the 50, right? More than just a few cents. So my stop moves up there. Boom, the move finally takes back off in our direction. As soon as it breaks out of that Keltner, I'm just going to be trailing every day along the 20-period EMA. And sure enough, we stay in the trade, so I'm leaving maybe 20, 30 cents under the 20-period EMA to allow for a little brief poke, of testing it as a support area. It jumps back up. Now it's the second time outside the Keltner channel, so I can take an exit up here, and that's exactly what we did. That's where we exited the trade. We got a signal to exit. So this is kind of how you can put, and I'm just about out of time. I ran a little longer than I thought. Excuse me. How you can use these indicators and this 2.5 Keltner to assess where your stops go and how you're going to trail it through the trade. So let's remember where we took this trade, and let's look at another trade. This is from the DXD Daily. It's a bear ETF, double leveraged bear ETF, and this is a trade that lost from our end of day service. And where the trade set up was right in, do you remember I talked about here, we expect a little chop in what I call no man's land, kind of that halfway point between the 20 period EMA and the outer band of the Keltner channel. To me, that's just no man's land. Anything could happen there, but you almost always see chop in that area for some reason. Well, that's right where we are, is kind of in this no man's land when the trade sets up. And so this was in theory, a trend. If you block out what happened after, it's a pretty good looking trend continuation trade. But what I didn't like about this trade is we entered it, I would have preferred to have seen the move down and below this 2.5 Keltner. Obviously we're fighting a bull market too. We're taking a bear signal in a bull market. As you can tell on this inverse ETF, the 20 and 50 are trading well under the 150. So that means it's kind of a risky trade to go in. I just didn't like where we took it in this area because it means a little bit greater risk because our initial stop, we want to set a little bit outside the 2.5 Keltner channel, and it comes down, and a couple of days later we get stopped out. So if you look at the difference between where you took entry there compared to where you took entry here, this is telling us we're at an area where we should see tremendous support. We're in an area that really it's an overextended move down, and we should get a rebound. And here we're just kind of in no man's land. We didn't get down to that extreme level I'd like to see. And we're taking a bear signal in a bull market, although after the strength of this down move in the market, up move in the inverse ETF, we kind of would have expected a little bit more follow through to that move. So let's look at one more example, and that was very recent. I think that was in March. Is that in March? Hal's here, he'll know. It was again in February into March, so that's kind of a recent example. Let's look at it even on a 5-minute chart. If you're an intraday trader, and we intraday trade some of the triple leveraged ETFs, the TNA, we like to trade from the 5 and 8-minute chart. You can catch some really strong moves in it. So we got a long signal here on this day trading. And my initial stop, I've added one thing, which is now I've added another little mid area on this Keltner channel, the mid area of the Keltner channel at 1.25, and that's to identify that chop area. So we get a long signal, and our stop is going to go just under that 1.25 Keltner. So I've got two Keltners on here, one at 1.25, one at 2.5. So I'm going to put my stop because the signal came just a little over the 20-period EMA, just under that kind of mid-area chop, because that's going to be an area of support. So the trade kind of goes up, starts to go our direction, comes back down and forms a price pivot. As soon as it gets up in that chop area, as it's coming back down, I'm moving my stop up to almost break even, leaving just a little bit of room under the 20-period EMA. Sure enough, the trade takes off our direction. Now, as I showed you on daily charts, 60-minute charts, you're not going to stay outside the Keltner very long. On 5-minute charts, when you get a strong bull move, you will stay outside there. And now I'm looking at that as an area of support. It'll, in a strong move on a triple leveraged ETF, you will stay outside there, and that will actually be your support area. Just as, we kind of look at the 20 EMA. So through the course of this trade, every 10 minutes or so, I'm just moving my stop up right under the 20-period EMA throughout the duration of this trade in case we get a sudden whipsaw and locking in profit. And then when it comes back inside the Keltner after staying out for that long, that 2.5 Keltner, then I'm going to take my exit right there. Here again, it's just showing how in virtually any time frame you can kind of use these combination of indicators to help assess where my initial stop's going to be and how I'm going to trail that stop if trade's going against me. Because it's very important, that you always trade in leveraged ETFs. You always want to look for that, 3 or 4 times return, your average return to your average loss. Because, when you catch 2 or 3 losers in a row on a triple leveraged ETF, you're obviously losing a little bit more money than you would if you were in an unleveraged ETF. So you want to know that that one big winning trade is going to make up for a couple of losers. So that is the end of my presentation. If anybody has any questions, email me, about what I went over. Please feel free to email me, bradpowell@rightangletrading.com. You can visit us, www.rightangletrading.com. And all the wonderful people who got up so early in the morning to join here. We offer 21-day free trials to our alerts. You may love what we're doing. You may hate what we're doing. They're currently closed because we were full. But what I'm going to do is open them just for the wonderful people who came out so early in the morning and joined me here today to look at the ETF market. So I'm going to send you the link in the chat right now. So only for people here today, I'm going to open up the 21-day free trials. So if you'd like to just, if you don't like what we're doing, we always say just paper trade along with us. You can kind of see some of these principles that I was talking about in action and put them on your charts and see how we're managing stops with them and looking for our initial stops. And come and have a little fun trading along with us.
Thank you so much. Thank you for having me, Value Charts. Thank you, Drew. Thank you, traders. It is my pleasure being here with you on this beautiful Saturday morning. I would like to share with you that for about 15-20 minutes, I will share with you what Alpha Wave Trader Method all about. And the most exciting part of the webinar always is answering your questions. So pretty please prepare your questions, specifically the instrument and the time frame you are trading, so I can analyze it for you. Initially, I would start with futures because that's mainly the focus, then main stocks and Forex. Again, method applies to any instrument and any time frame. So let's start, shall we? Very important to read United States government required disclaimers about risks involved in trading. Very critical to recognize that trading is pretty serious business. So what makes Alpha Wave Trader so unique and so different? I don't use any software whatsoever. I don't use any indicators. I've traded with indicators and software for a number of years, and I recognize that the most important component in trading is price action. Price tells you everything you need to know. Price tells you where the reversals are, where the most important levels are, where to enter, where to stay out. If you will only remove all the indicators, you'll be amazed how much you see. Let's go through a number of examples. Here it is. All of these levels are Alpha Wave Trader proprietary Fibonacci levels. It is a free tool that's available on any platform. What are you witnessing on Oil Monthly? What has played out when oil reached the end of the minor trend, all levels drawn in 2011? Oil had staged very powerful bounce as expected when it came to decision point 1. And why had oil been so slow? What has oil been doing 3rd month in a row upon visiting this level to the upside? Prior, it had staged very powerful reversal, correct? Because the short trend found the exhaustion level first time here and second time here. But seems like buyers are extremely weak on Oil Monthly and not finding enough power to blast through. If they will, the next level will be 106.50. That's how price moves between the levels. But each level is very important level of support and resistance that identifies these reversals areas. So let's keep going and I will keep showing you the examples. Though this is all we do in our day trading room where I demonstrate the method, and I look forward posting the invitation for you for the next week to come and observe how I demonstrate the method. Very important to pay attention to pure price action where I enter markets using pure market structure, and this is most critical component of the puzzle, exiting markets using Fibonacci levels. because you may have the most powerful entry of all, but if you do not know where to exit, that becomes the most essential part of trading, correct? There we go. Invitation is posted to entire audience. So why in the world do I do this? Why do I pay attention to only price action? For a number of years, I traded indicators. For a number of years, I worked with programmers. And I recognize that every single indicator that exists mimics what price did after the fact. So this is typically how indicator works. Mathematical formula applied to a number of candles, but most of the time indicators are late to plot. Keyword, most of the time. If you found the indicator that works, stick with it. Very, very important not to repeat the cycle of jumping from indicator to indicator, software to software. If you found something that works in trading, rule number 1, stick with it. If you haven't found something that worked in trading, don't use it. Don't keep using it. Recognize that every single indicator most of the time is delayed and will not show you how the markets will behave in the future when price in fact tells you so. For example, what played out on S&P daily? Once again, this is the most critical level in the market structure. All the levels drawn in 2013. Price came to the end of the minor trend and S&P staged phenomenal collapse, showing to us that bullish trend was pretty weak, giving very powerful shorting opportunity at this area. What have the buyers done? Staged phenomenal reversal. All the way to here. That's why I've been spelling out last week. Shorts coming up, be very careful. One of these days, very soon, since Monday, we've been waiting for very powerful short day, and finally sellers picked up this theme on Thursday and Friday with vengeance. On Monday, I expect quite a bullish pullback, but this is pretty vicious bearish trend. Bullish pullback will be only temporary. And this formula remains the same. It doesn't matter if it's S&P daily. It doesn't matter if it's the favorite stock of all. Let's take a look on Apple monthly and let's see what it had done. Let me find Apple monthly. All the level on Apple monthly drawn since 2010. Since 2010, Apple was spelling out very clearly where price will start staging reversal. This is where Apple staged bearish correction for the first time, visiting reversal zone 2. And finally, with confirmation, staged spectacular collapse. I remember that right before Thanksgiving in 2012. Very important levels where not to enter into and where to monitor for very powerful reversals. But this is very critical point. Price moves the same way on any instrument and any time frame. And where has Apple been struggling? Pay attention to the structure. How many months has Apple struggled against decision point 1? Months 1, 2, 3, 4, 5. Blasted through, taking a pause for 2 months against decision point 2. And here it is, finally Apple trying so hard to break to the next reversal zone. Reminding you, do not ever acquire position into reversal zone where Apple staged the collapse for 3 months. And this is the magic of Fibonacci levels. This is exact same formula that applies to any instrument and any time frame. So here's an example of one of my most favorite indicators that I tried to use for so long, moving averages crossovers. Fabulous, amazing, and magnificent as long as market does not go into consolidation. How much does market consolidate? 30 to 40% of the time, market stages very, very small formations. So therefore, moving averages are spectacular and fabulous in trending markets. But in consolidation, ouch. Here's an example. I received a call yesterday from an oil trader. I typically do not trade on Fridays, but I had to substitute for my amazing partner, Danny, and I was absolutely tortured. Why? Because oil was screaming out loud, "Do not touch me. It's a correction. Walk away from computer." And this guy called me and said, "How in the world do you know that?" Because I just pay attention to price. That's all there is on my charts. Nothing less, nothing more. That's all that matters. When price is telling you it is in correction, the smarter thing to do is to walk away from computer. There is absolutely no need to babysit or trade corrections. Very, very critical and very important to separate corrections from reversals. And when price tells you walk away from computer, it's essential to do so. Very, very critical point to recognize that market does not always have a point of entry. When market gives you corrections, walk away. Here's an example of S&P. This was us on April 24th, Thursday. We came to the markets in Alpha Wave Traders Club, which is our graduate room where we meet before trading room open. And we said, ouch, buckle up. Collapse will be spectacular. But we know better not to acquire trend position anywhere near reversal zone. This is where trend starts showing exhaustion. Anywhere in this area, 1870 and lower down, knowledgeable traders should never, ever, ever acquire position. Guess what we had done? We've taken only long trades. 3 long trades on Thursday. Before I had taken the trade, we had a couple of visitors in the room. People were saying, do you know what you're really doing? I said, I ain't shorting into this area. 3 bullish trades between 1 to 4 points each. And rally continued with buyers picking up this steam at the market closed. But again, I spelled out, it's only a corrective rally. Bearish trend is vicious and it will continue, which it had done so. But once again, the pullback from reversal zone and trend exhaustion was very, very clear. Market's rally was from 1864 all the way to 1877, reminding you, do not ever acquire trend position anywhere near this level. Price becomes very, very unpredictable. You learn to short at the inception of the trend here, and you do not acquire position anywhere near here unless it's reversal trade. That's all there is. Pure price tells you far in advance everything you need to know. Here's an example of a chart of one of my students. He came to me trading for 20 plus years. And he said, I've been trying to trade for so many years. I've used every single indicator, every single software that exists. And I said, okay, let me take a look at what you have. In private mentoring, I log in into the trader's computer and I see what exactly trader had been doing and trading. And this spelled out to me very, very clearly why trader had been struggling for so many years. When you use so many indicators, you do not see anything. How many indicators are here? I lost the count after 15. Every single indicator tries to mimic pure price. And that's why trader really had not learned anything despite trading many years. It looks very exciting. It looks like fantastic video game, but in fact, there is absolutely no knowledge had been acquired despite years of trading. So once you remove all the indicators, you know extremely clearly where to take profits and where not to acquire a position. Once again, all the levels you see here in the charts are the levels I developed studying pure price and recognizing that nothing in this world is random. That exact same symmetry you see in everything that surrounds you, in flowers, in nature, in waves, in dance, in the mirror, is found in price. It is exact same formula that applies to every instrument and every time frame. So this is all I do. I pay attention to price and I apply Fibonacci levels. When 4 critical rules are obeyed, our students and I take an entry. This is an example on short on oil. Short from 101.90 reached exhaustion level when it came to 160. And where is oil struggling to? Oil is struggling to break to the upside on reversal zone 101. So that's all there is. Alpha Wave Trader proprietary Fibonacci levels. This is Fibonacci tool that's available on any platform. This tool is free and so is priced. But the key is to learn those very, very critical rules for trend inception and trend reversal before you ever apply the levels. So what exactly is Fibonacci? Fibonacci is a very unique concept that was brought to the fore by Italian mathematician in 13th century by the name of Leonardo Pisano. It is very fascinating sequence which found to impact our everyday lives. This sequence that once again confirms that nothing in this world is random. And more time you spend in the markets, more you recognize how amazing emails I get from my students who are absolutely fascinated and mesmerized by this sequence. One of the recent graduates, Tony, had been emailing me very, very fascinating messages, how much he's fascinated with what we see in ETFs, in stocks, in various instruments that he trades that I frankly never look at because the formula remains the same. So what exactly is Fibonacci? This is the only numbers I trade. I pay attention only to Fibonacci numbers. In the trading room, I demonstrate the method on S&P and oil. Graduates trade Forex, stocks, options, ETFs, daily, monthly, weekly. Whatever instrument exists, formula remains the same. And if you listen to our graduates, you could see what they trade. Currently, Martin trades Forex 15 minutes. Janice, beginner trader who had never, ever taken any course, doubled her account, trading, day trading S&P, and currently she added oil. Catherine trades DAX, which is the beast of the indices. Tony trades ETFs, stocks, and other instruments. I'm just looking at the audio testimonies as I know all of my graduates very, very personally. Dean trades options, on stocks and futures. So there we go. Here's golden ratio. That's all that matters in trading. And this is a sequence that keeps playing out each and every time. And this is a critical principle I use on each and every trade that plays out. And this is all we teach in the course, those very, very critical 4 rules. So here we are. Rule number 1, take the inception of the trend only. Rule number 2, do not ever trade wave 2. Do not ever trade wave 4. Those are corrective waves. Respect what price is telling you. The wave 1 is a wave that shows you where price will become completely exhausted. So, if you were trading S&P weekly, you would see extremely clearly what S&P is struggling against, how many weeks in a row. Week 1, 2, 3, 4, 5, 6, 7, 8, S&P is struggling, reminding you this is the most critical level in the market structure. We always have minor trend, we not have major trend. Absolutely essential and critical to recognize and remember that. This is a level you never want to acquire trend position. If you are trading weekly chart, this is your first target. The method works as clearly explained on any instrument that has price, which clearly every instrument does. And that's all there is. If you know the inception of the trend, you know where trend exhaustion levels will be. And that's all that matters. And this is the rule that identifies all these levels. So once again, respect the inception of the trend, enjoy the rally, or stay out if this is a correction. Do not ever trade wave 2, enjoy wave 3. That's the most powerful wave in the market structure that is always present. Do not ever acquire position at the end wave 3. And those are critical rules we apply in the room, in our education course. So here it is, a couple of examples, and I look forward answering your questions. And I look forward seeing you in the trading room next week. Once again, the invitation to the trading room for Tuesday through Thursday only, because Mondays typically are very, very quiet days. And again, the method I demonstrate on S&P and oil in our day trading room, but method applies to any instrument and any time frame. We have an open forum. You can ask any questions of our students. Here's an example of ranging markets. Absolutely essential to respect small market formations. Price respects Fibonacci levels. Here it is, 261.8. Price is struggling to blast through. Thank you, bro. Thank you, Haley. Love, love, love when I hear from women. About 20% of our graduates are women. And if you listen to audio testimonies, our recent graduates, Catherine, the most courageous woman trader I've ever met. If you know anything about DEX, there is no more volatile instrument than DEX. And to see how inspiring she is, when she comes to the room on occasion, she takes the mic and she speaks and she shares what she's done that night. It's just awesome to see how fantastic she's doing. Make sense? So here it is, trading markets respect, very important level. Trading markets showing you, here it is, the end of wave 3. Do not ever acquire position into 161.8. Bounce, correction. Do not trade corrections. Know where price will find this very, very powerful ultimate reversals. John, once again, what have I said? I said, nothing in this world is random. It doesn't matter if it's stocks. It doesn't matter if it's Forex, monthly, daily, weekly. If it's Renko charts, it's a confirmation that nothing in this world is random. Nothing. That's why they follow Fibonacci levels. Does that make sense? If it doesn't, I have nothing to do with Elliott wave. I didn't know Elliott wave existed when I developed my method. My method is very simple. Rule 1, Rule 2, Rule 3, Lay 4. Specific, not subjective and not speculative. Specific to the tick. That's all there is. Pure price for entry and Fibonacci for exits. This is the most important level in the market structure, wave 3. Clear? That's all that matters to me. 5 waves. Do not ever acquire position at the end of wave 3, only in the beginning. If you don't know where wave 3 is and you start acquiring a position at the end of this level, ouch, bad idea. Here's an example. Let's take a look at what our amazing Sarah trading currently. We currently have a graduate, Sarah, who trades and loves Amazon. Is it possible that Amazon Weekly, when it came to reversal zone, all the levels drawn in the summer of 2013 came to reversal zone and collapsed completely, finding a bit of a struggle when it came to the end of the minor trend, reminding you how essential it is to respect this level and where to take profits off the table. And this is specifically what we spell out in the course in every single class. Do not ever acquire position into reversal zone. Monitor for essential and critical rules. Separate the correction. Amazon danced in correction for 4 weeks and then staged very powerful reversal. Very, very important and very critical. And once you learn those very important rules, you know what not to enter into, and you know where to take profits off the table. That's all there is. Pure price for entry and Fibonacci for exits. And next, I don't have enough time in the webinar to spell out those rules. I explained them, 4 critical rules, and we identify them on every single trade I take. In private mentoring course, I teach you on the instrument of your choice. I work with Forex position traders. I work with option traders. In education course, in our group sessions, we concentrate on S&P and oil, but currently, as I said, we have Forex traders and stock traders who trade long-term charts. And here's an example, once again, of alpha pattern. Take the inception of wave 3. Do not ever trade wave 4. Stay out at the end of wave 3. Those are the rules that we teach consistently and ongoingly. Of course we short. We short and we long. If market collapses, absolutely. But if you know anything about human psychology, you also know that 100% of women have bias to the upside, just like 100% of men have bias to the downside. Make sense? So I'm almost done. I will highlight to you a couple of examples, and let me take a sip of coffee so I can answer your questions. That's what we do in our day trading room. I'm showing you multiple examples and I look forward answering your questions. So here is oil very, very choppy, showing you the importance of Fibonacci levels. Yay! Here is the cleanest chart you will ever see. Google 1-minute chart. It doesn't get any cleaner than that. This is all in front of you, alpha wave trader method. And if you come to my YouTube channel, you can see multiple live trade examples. Very, very important. This is all in front of you. This is what I teach. Here is the inception of the trend. Buy long from 520. Stay out of wave 2. Walk away from computer. Enjoy the rally inception wave 3. Do not trade wave 4. Here the trader had gotten lucky acquiring a position at the end of wave 3, but barely having any space to the upside. Yes, we're almost done, and I look forward to answering your questions. So that's all there is. And I highly encourage you to review this video. This was spectacular and phenomenal and awesome, as we witnessed on that particular morning, very, very dangerous Fibonacci dance. It was very, very fascinating. I encourage you to see this. If you come to YouTube, you would see how marvelous and fabulous it was. And if you come to the website, you can find all the information you need. If you click on this orange icon, you can listen to audio testimonies. We'll be posting the latest testimony from Jose. Martin trades in Croatia. He trades Forex. Janice is a beginner trader. She's never learned or done one trade in her life before she came to us, and she already doubled her account. She trades S&P and oil. Tony is a full-time doctor, trades ETFs and stocks. Kathy is becoming my dear and amazing friend and coming to visit me in California. She's the most courageous woman trader I've ever met. She trades DAX. If you know anything about DAX, you can't ignore and respect this woman. Dean, options trader, trades stocks and options on ETFs as well. Jim G trades Forex and so on. I know my graduates very, very personally. I adore those who are serious about trading. That's all there is. Pure price is all you need. And those are two key concepts I teach in the course. Pure price for entry and Fibonacci for exits. No software, no indicators, any market and any time frame. Make sense? That's all there is. 4 is corrective wave. I spelled it out. Only wave 1 and wave 3 that matters. Here is an example of one of the trades based on alpha wave trader method. S&P 13. Collapse from 1877. What has happened when price came to reversal zone? Reminded you, do not ever exercise greed. Do not ever acquire trend position into this level. Formula remains the same. Doesn't matter if it's Amazon weekly. Doesn't matter if it's stocks, options, Forex, what have you. It is all the same formula. It is very, very important to recognize that. So, give me just a moment. Pretty please, prepare your questions. Let's start with futures. Then I will answer major stocks and Forex. So let me answer the questions I see. Hello, Michael White. Fabulous to see you. Hello, hello, Haley. Hello, Johnny. I hope you can hear it well. I see the question about Aussie dollar. Any other questions? Please let me know. Aussie dollar, I need to know the time frame. Are you asking me to analyze oil weekly? Is that the question? What time frame would you like me to look on oil weekly? On oil weekly? Excellent question. Let's go on oil weekly. This is oil weekly levels, all the levels drawn in 2013. Oil weekly staged very powerful reversal from decision point 2 in 2014. First time actually mid-2013, second time in January 2014. What has oil weekly done when it came to the end of the minor trend? It staged quite a powerful collapse from 103.70, correct? To the downside, oil weekly had found the buyers once again, reaching the end of the minor trend. Tony, it's 100% up to you to what time frame you use. 100,000% up to you. What instrument you trade and what time frame. Choice is yours. If I day trade, I use 1 hour as my guiding light. If I position trade, I use larger time frames. The question I'm answering currently is oil weekly. I expect quite a powerful bullish rally on oil once it finally finds support at 100. I expect the 100 to be a temporary support. This is what I expect oil to do. Collapse until 100, pull back, and then collapse further up. But this is very important to monitor for buyers, for those 4 critical rules. How powerful will the buyers be? Make sense? So monitor for a pullback on oil 100. Would like to show you oil daily, which we pay attention to a lot in our day trading room. Oil was spelling out very clearly that bearish trend is spectacular and powerful. But what has oil done when it came to reversal zone 2? 2 days bullish pullbacks that ended where? Here we are. Excellent question. So let's wrap up futures so we can go to Forex. Any other questions? Gold. I'm not sure what it means. Is it gold 1 minute or is it gold daily or weekly? What time frame on gold are you asking me to analyze? Weekly. Gold weekly coming up. Pretty please prepare all other questions. I look forward answering them. So let me take a look on gold weekly. And let me show you why gold had found such a spectacular bounce. Here it is. If you trade gold, you would know all of these levels since early 2012. Gold had found very powerful reversal. This was the first time gold came to this level, finding correction, not a reversal. And here is the gold second time. Lovely, beautiful buying opportunity, impressive rally. And where is gold struggling currently? What is gold pointing down currently on weekly? Let me give you where gold is heading next to. It is showing potential of revisiting the reversal zone once again. So this is where I see gold heading next to. I see gold choppy, and then eventually making it all the way down to this level. It's very important to monitor what gold will do at the end of the minor trend. If there is no serious buying pressure found, gold will continue lower down. All the levels are proprietary Fibonacci levels that generated based on those 4 rules that I highlighted throughout the webinar. Make sense? Day trading on Apple. Okay, if there is no other questions on future, I look forward answering your questions. So let's go. The first question was about Aussie dollar. Aussie dollar, what time frame daily coming up? I love Australians. I think Australians are the happiest people on the planet. If you've never been to Australia, I highly encourage you to visit. We have amazing Neil, our Brisbane Puma, waking up and coming to the trading room 1, 2 o'clock in the morning. Here's Aussie dollar weekly. What has price done when it came to reversal zone 2? Isn't that lovely? As soon as price came to reversal zone 1, you can see the buyers reminding you, do not ever acquire trend position into that level. Bad idea. If you know the critical rules, you short here. You do not ever acquire position anywhere near this level. Price becomes unpredictable and very, very funky. Because price would do 2 things. Either a correction or reversal. Make sense? Very, very important to identify that. And here we are. Initially only a correction and finally powerful reversal. But not far off from this level, sellers picked up this steam. So let's take a look currently on Aussie and let's see what price is doing and where it is currently. And we can certainly take a look on very important level that you are asking me for. Again, guys, if you want to send me an email at any point, we have plenty of students who would respond and contact you in private. We have very, very happy alphys. And you can actually see the pictures on the website. So here it is. Isn't this marvelous? God works in mysterious ways, reminding you know where the end of the minor trend is. If you apply those 4 critical rules, you remember this is the most important level in the market structure. Currently, if you were bullish, you do not buy Aussie anywhere. You are monitoring for the strength of this pullback. This is not the time to buy Aussie. This is time to stay out and monitor. I don't see any power on the seller's side. I see the weakness, absolute weakness. I would monitor for this bearish correction to end. Based on alpha wave trader rules, you had opportunity to buy at 8800. Nowhere near this level. My pleasure, Jamie. Amazon. So let's keep going. I want to be fair. And again, I want to show you, if you come here, you can read my story and you could see pictures of our students. That's me in magenta shoes. Magenta is my favorite color of all. And here's our students. This is my amazing Danny. Danny is my current partner. He's group educator. This is Kenny. This is our amazing students in Singapore, in Thailand, in Florida. So we have an open forum. We're building community. This is Don in Annapolis. He trades gas. So as you could see, we keep updating pictures. We're sort of running out and trying to figure out where to do this. So next question, please. If you come to the performance page, you could see our trading results going back 2 years. Very, very important to recognize where you need to open this content. I don't like when this is happening. So please go here to see very, very important latest updates. Make sense? So, we have traders who trade on Renko charts, tick charts. We're trading on range charts. That's what we demonstrate the method on. Make sense? That's my picture, my least favorite thing of all. And you can learn about method on this link. So next question, Amazon Daily. Let's go to Amazon Daily. Thank you, David. Not at the moment. I'm not. At the moment, I'm very, very sleepy. And I'm very fascinated with price. I love, love, love what I do. I can't get enough of the price. I don't understand why can't the whole world see how simple this is. Take a look. Amazon Daily. Isn't this marvelous? I didn't touch anything. Short. This is my arrow that was placed from many, many days ago. Short, short, short. In February, is that clear? Yes, it's all the same GV. It's all the same formula as I spelled out. Here's Amazon Daily. The same formula, oil 21 range. Exact same formula. This was oil yesterday. This is when we took only long on oil. This is our guiding light and what we use in the trading room. Gold hourly. What happened when gold came to reversal zone? All levels drawn on April 20th. April 23rd, spectacular push to the upside. We had taken only longs in this area. Second time around, long only. And this is when I was in the trading room yesterday. I said, unbelievable, endless corrective fluff. My bias remained only long. We had taken 2 long trades that went to reversal zone. Guess where my trade had ended? It was not able to break through reversal zone 2. It was 25 tick trade. Oil continued in correction. It's worthless. It's not tradable. And if you look on smaller time frame, it was spelling out. So, thank you, bro. I stopped practicing nursing many years ago because unfortunately it's very rewarding emotionally. It's not very rewarding financially, is it? So, this is all there is, traders. Other questions? Pretty please explain to me. Copper Weekly, if I only knew, nobody ever asked me a question about Copper Weekly. 1 second, please. Copper. Let's go and let's find copper. What a fascinating question. Is it a future? On the future? Hold on 1 second. I explained to you. I don't know when that will happen. I know the levels. Make sense? Copper. Let's search copper. What is the identification? Description. Is it the future? We already looked on ES Daily. SLW. What? I spelled out on any instrument clearly. I spelled out our full-time doctor trades ETFs. You can listen to his testimony. Anything that has price. HG. Hold on 1 second. Are we going to other instruments? Let's find copper, shall we? Copper Industries, that's all I'm pulling up. I'm waiting for the answer on copper. What is copper under? Copper ETF. I do not trade the ETF. It's coming up as a future. I don't have access to ETFs. HG. Okay, let's take a look on CBE as a stock. Trying to wrap up copper. Next question was on bonds. Bonds, the question was, hold on one second. Watch time frame bonds. Let's go to bonds. We already added. Oh my God, bonds. What is it on Ninja? ZB, thank you. Here we go. We have ZB. Next question. ZB hourly. Any other questions? HG. Not sure what HG is. Let's do that. What is HG stands for, please? All right, so let's pull up. HG is copper. Marvelous. So let's go. What time frame are we looking at? AG. HG did not. Okay, guys, let's go to what we have. We're running out a little bit of time. So let's go on what we have. The only thing I can pull up on copper is the stock. Would you like me to look on stock? I will gladly do that. Hold on, please. Let's stay focused on what I can pull up at the moment. I'm looking on your questions, GS. Okay, a few more questions and we are done. We already looked multiple times on S&P, Goldman Sachs coming up. There is no stock of copper. Exactly. All right. We have 5 more minutes, so let's rock and roll. Let's see what we have. The questions that I have is bonds. What time frame on bonds, please? Day trading bonds. I admire your patience. Absolutely admire your patience. And I don't like what happened with Mr. L. Arian. He was replaced by a team of 6. Did you know that? Team of 6. All right, so we are paying attention to copper hourly. Copper hourly staged quite a spectacular rally. This is where copper hourly is currently. Copper hourly collapsed when it came to decision point 1. How many hours? 1, 2, 3, 4, 5. Decision point 2, 1, 2, 3, 4, 5. Reversal here. What do I see? I see the weakness on the side of the sellers. I will be monitoring for buyers to pick up this theme. Definitely very, very close to decision point 1. 134.24 is a very, very powerful buying area. Clear? Very, very important. I don't believe in trading Russell anymore. I developed my method on Russell. I traded nothing but Russell for 5 years. Russell vanished as the indice. Please learn about ICE exchange And please recognize the danger of trading very low liquidity instrument. Next question, we have 2 more minutes, was on Apple hourly. We already looked on Apple multiple times. One more time. This was phenomenal rally. If you will ever get in, if you want to get in touch with Dean, send me an email. Dean came to the room and reported to us that he bought Apple. This was the most phenomenal bullish rally I probably have ever seen. Do you know why it played out? Here it is. Price is not even able to all the way down to that level. That was phenomenal, most powerful bullish formation I've frankly ever seen in my life. Make sense? Very, very important and very, very critical. So traders, let me just show you very, very important offer. 1 second, please. Once again, everybody saw the invitation, correct? To the trading room. So if you would come here, you would see how important it is. 1 second, please. Trying to pull up this slide. Not sure why it's giving me such a hard time. So, here it is. I look forward to seeing you in the trading room. I thank you so, so much for your time. And once again, I'm always available for any questions, any comments. I love, love, love what I do. I will always answer your email. And feel free, if you would like to speak with any of our students, we have an open forum. I send you info to our students, they call you back. I believe in karma. I believe that nothing in this world is random. I believe that price is magic. I believe that you're in charge of your destiny. I believe in symmetry. I believe in goodness. And I believe if you believe in yourself and you follow the rules, the skies are the limit. There is nothing possible in trading without you as a trader. Remember, always and forever, you become what you believe. So if you believe you will be successful, if you believe you can reach for the skies, for the stars, you will end up on the moon. Discipline, patience, pure price, and Fibonacci is the key. Thank you so, so much. It's my pleasure being here. I'm always open. If you come to the contact page, you can see very, very clearly where to find me. This comes directly to me. My pleasure, traders. My pleasure, Sabhir, Jamie, Roy, Sandy, Dennis, Haley, Barry. Thank you so, so much. I will answer more of your questions in the trading room. Once again, invitation is posted. Have an amazing weekend, everybody. Look forward to seeing you on Tuesday.
Again, my name is Dave Aquino. I am the options and stocks live trading room specialist for Microquant. We run a weekly, a daily live trading room from 9 a.m. until 1 o'clock p.m. Every trading day. And we do a number of types of trading throughout the day. But what I'm going to talk about are the strategies we utilize in the room regarding weekly options. Okay, so what we're going to go ahead and do is get started. Let's see here, make sure everything is working. Okay, so as we go along, feel free at any time to submit any questions via the GoToWebinar side menu. I'll try to address the questions as they come up if they're pertinent to the subject that I'm talking about right now. If not, I may forego the question until a later point in time at which they can be answered, or maybe towards the end with the final set of questions. So again, thank you. All right, a little bit of information about me. I am a 1995 graduate of Vanderbilt University. Soon after graduation, I joined Merrill Lynch as a general securities broker, and I was with them for a number of years. Then I transitioned from Merrill Lynch to the Vanguard Group, in which I worked for over a dozen years in the asset management group, managing ultra-level clients, dealing with cash flow issues and appreciated securities, generating cash flow strategies with options and tax loss harvesting focuses also. This slide is actually 2 months old because last Friday I actually celebrated the 1-year anniversary of the Stocks and Options Live Trading Room. We've been actively at it for over a year. I've been very successful, and we have a lot of fun in the trading room. So again, happy 1-year anniversary, everybody. All right, our quick risk disclaimer. We want you to know that trading or investing carries a high level of risk, and it is not suitable for all persons. Now, before deciding to trade or invest, you should carefully consider your investment objectives, experience, and ability to tolerate risk. Please read the rest of this disclaimer, but basically what it does is it boils down to that past performance is not necessarily indicative of future results. One moment, please. Okay, and this is the CFTC Rule 4.41, and this is a government-required disclaimer. Again, basically it all boils down to that past performance of any trading system or methodology is not necessarily indicative of future results. Okay, so let's go ahead and get started with the weekly power option strategies that I'd like to talk about today. Now, those of you that are not familiar with the world of options, you've probably heard about it in investment circles, and maybe your curiosity has been piqued in the past. Maybe you've picked up an article or a book, and basically those topics usually cover the academic side of options, based on how they're created, what factors influence their pricing, and then maybe some general investing type strategies. Maybe you've heard of covered call strategies or buying calls or puts, but what I'm going to go into a little bit further depth, understanding some what we call the Greeks. Basically, these are the components of options that dictate their pricing structure. I'm going to talk about the Greek aspects of options. I'm going to talk about one of the most important Greeks, which is time decay, and how that is traded on a weekly calendar. Then I'm going to go into a couple of actual strategies that we utilize in the Options Live Trading Room, and that is the weekly credit spreads that we sell. And then we're going to talk about a new strategy that we've been using, and basically selling volatility premium for income. Okay, the first part is the essential Greeks. Now, we're not talking about the people of Greece, but in this particular case, we are actually referring to the components of the Black-Scholes option pricing model. Basically, this is the model that was created by Fisher Black, Myron Scholes, and Robert Merton in their 1973 paper. Now, this 1973 paper basically created the structure of a formula for calculating the fair value of an option, and it's a derivative whose value is based on some sort of underlying asset. Now, the reason why we call them Greeks is because the parts of this equation that controls the pricing, they're noted with the Greek characters. Okay, so if you had to go through this every time you wanted to think about your options, it's complicated, it's intimidating, but it's not necessary. There's certain aspects of the pricing model that are important. And oh, by the way, this is the formula that won the 1997 Nobel Prize in economics. All right, the two Greeks that I want to touch on today are the ones that I feel that have the most influence in our weekly option strategies. The first is delta. Delta basically reflects the change in the pricing of the option based on changes in the underlying stock price. So if you remember, delta is related to price. The next Greek that I want to talk about is theta. Theta is basically the relation of the option and its sensitivity to time to expiration. If you know anything about options, you know that options have a limited lifespan. And as their lifespan gets shorter and shorter, that's what we refer to as time decay. As we get closer to expiration, the sensitivity of the option price to time decay really becomes exponential. Whether exponentially higher or lower depends on whether or not that particular option is in the money or out of the money. But the first one is delta. Now, delta, again, is the option's sensitivity to changes in the underlying stock price. It measures the expected price change of the option given a $1 change in the underlying. So the best way to keep this straight in your head, if you are trading Apple and Apple goes up by $1, and the option that you have, if its delta is 0.70, then every dollar change in the value of Apple is reflected in a 70-cent change in the value of the option of Apple. Okay? So that is the relationship. If the value of Apple falls by $1, then that particular option could fall by 70 cents. Now, lots of times people ask me, Dave, why do I buy those expensive options? I want to buy the 20 or 15 cent option to make a lot of money. Those are what we refer to as deep out of the money options. Now, deep out of the money options really is a very difficult way to trade because when we're deep out of the money, the price of the underlying has to change a lot before you can actually make money. Because if it's a delta 10 option, for every dollar that Apple has to move, you only change 10 cents in your particular option. So lots of times people get confused in which they buy options, they buy the really cheap ones. The stock makes a $5, $6, $10 move, and the value of their options changes very little, and they wonder why they're not making more. So basically is if you buy very low delta options, you may not even make a profit despite a large move in the underlying. That's why in the live trading room, we tend to go with delta 70 out of the money options and as low as, say, delta 50. But we really don't go much lower than that. Okay, this is the curve of delta, and basically what this is saying, that when the option is in the money, okay, that delta approaches 1. When we are deep out of the money, or way out of the money, the delta approaches 0. And this is, basically right here, this point right in the middle, this is delta 50. This is when the strike price and the underlying price are basically the same number. Okay, as you can see, more in the money, then the options tend to trade more like the stock. Out of the money, it becomes much harder to benefit from a move in the underlying. The red down here is basically the mirror reflection, and these are when we're talking about puts and the stock actually falling. But the midpoint also is delta 50. Okay. All right, the second factor that I want to talk about, the second Greek, is theta. And theta is going to be important for the rest of the presentation this morning. So try to get a good handle again on theta. Theta is the option's sensitivity to time. It is a direct measure of time decay of the option. This is very important. Again, because options have a limited lifespan. Now, this amount increases rapidly as the option approaches expiration. Now, what I mean by it increases rapidly, its effect increases rapidly, and that effect is positive or negative based on are we in the money or out of the money. Now, for again, time options have general time frames. You may have a monthly option that could be anywhere from 1, 2, 3 months until expiration. Now, for those monthly options, the greatest rate of loss in time decay is the last month. Okay. Now, we also have other types of options we refer to as weekly. So they're created in these interim periods between monthly expirations. Now, every single week, if the stock that you trade has weekly options, then the greatest rate of time decay is in the last 1 to 2 days. And we use this to our advantage. Now, option sellers use theta or time decay to their advantage, collecting time decay every day. The same is true for credit spreads, which are basically the same thing, and they are generally selling strategies. Now, what we're doing is this. At the beginning of the week, we are selling something that may have a value of $1. Okay, this is on Tuesday. Okay, Tuesday, it's worth $1. Wednesday, if price is behaving and doesn't go against us, then it becomes worth roughly 85 cents. Okay, Wednesday, Thursday comes along. By the time Thursday, if price is not moving against us, now it's Thursday. Okay, now this option is worth 50 cents. Okay, time passes, it's Friday. This is the last day of its life. If it's not anywhere near the short strike, this option could go to 0. Why is this important? Because we are selling it. We have the potential of earning $1 per option. We sell it for $1 here on Wednesday. Okay, it's only worth 85 cents. So if we sold it for $1 and now it's worth 85, somebody will sell it back to us for 85 cents, and our profit is the difference, or 15 cents. Okay, if we hold it, now it's Thursday. What we sold on Tuesday is now worth only 50 cents. Now we can buy it back for 50 cents. Do we hold it? Okay, if we go ahead and continue to hold it, then it becomes Friday. And on Friday, at the end of the day, as long as this option closes out of the money, what we sold on Tuesday for $1 is now worthless. We don't have to buy it back. We get to keep the entire $1 in profits for ourselves. Okay, that in essence is the idea of what we are doing with time decay for it to be on our favor. Now, if it's the opposite and you come in and you buy this option for $1 on Tuesday, hoping it's going to move your way, now you have time working against you. Because if it doesn't move in the direction you think, by Wednesday, it's worth 85 cents. Thursday, it's worth 50 cents. And if you are unlucky enough to be holding it on Friday, it's out of the money. There is no value. You lose 100% of your investment. Okay? Right there. So we like to be on the opposite side. We like to be the seller because we cannot change the direction of time. It always decays, it always goes down. So we like to be on the selling side of things. All right, again, here is the time decay curve. If we look out, basically this is 3 months here. 3 months, we have this is a general factor of about 5.1. 2 months, we're looking here. Now it is 4. What's that? 3.8. It's been a while since I've actually seen this chart, but that's 2 months out. 3 months out, you see the value here is 3.1. And then 15 days out, it's worth about 2. 5 days out, it's about 1.3. And then 0 days out, it goes to 0. So you can see the steepest part of this curve is right here, the last anywhere from 30 to 15 days. Okay, now the same curve is in place, except it's a much steeper fall when we're talking about weekly options. This is going to be 5, 4, 3, 2, 1. Those are how many days left till expiration. So this is why we go in as an option seller, because we want to take advantage of the value of what we sold. We want to take advantage of that dropping. Okay, any questions on those Greeks? Again, time decay and delta, or time decay or price action. Okay, guess no questions there. All right, so let's get some practical trading in place here. Now that we understand the two factors that influence the pricing of options, Subkir, I'm glad it's straightforward. Lots of times people get hung up on other aspects of options trading. We like to keep it very simple in the trading room. Those are the factors that are most important and dictate our profitability on a day-to-day basis. So that's what we like to focus on right from the beginning. So let's get some practical trading and talk about some strategies that deal with time decay and how we plot this time decay on a weekly calendar. All right, again, this is a same slide from earlier, but again, basically talking about time decay. All right, we want to be a seller, an option seller, so that we can collect money based on time decay. We'll sell something that is depreciating, and hopefully at the end, we don't have to pay it back. Okay, basically, how do we plot this time decay on a weekly calendar? Here, again, these are the number of days out. We have 4, 3, 2, 1, 0, because there are no more trading days left on those options. That is the closing day on Friday. But what we do is, again, we do buy calls and puts, but we do buy them to hold them for very short-term time frames. But again, this is what we want to do. We focus on swing trades and selling credit spreads. Okay, on Monday and Tuesday, credit spreads. Wednesday, this is the last day usually that we actually sell credit spreads, so that is the last day. The main reason is, keep in mind, as we're going through the week, the value of these options are decreasing. So in order for us to get any sort of reasonable time premium, we really want to do it on Tuesday. And actually in the live trading room, we have a special session at the end of day on Tuesday that we actually get back into the room from 3 o'clock to 4 o'clock, in which we talk about options for credit spreads that we're actually selling. Okay, and then we spend all of Wednesday, Thursday, and Friday managing them, as well as doing intraday directional trades. But again, that's the time frame. Again, I think there we laid it out here. We want to sell credit on Tuesday and Wednesday, and then last possible moment on Thursday. Okay, and then we just manage it on Friday. Good question. What happens, Dave, if we make a lot of money here and here? What do we do? Do we still hold it into Thursday and Friday? No, you can actually sell it. Okay, you don't have to hold it, your credit spreads, through Thursday or Friday. We do have certain parameters that we'll use that we'll go ahead and harvest some of our profits. We will buy back the credit spreads that we sold just to make it to limit our risk. If we can make a week, basically what we would normally make in a week, and we can make them on Tuesday going into Wednesday, that's fine. Therefore, our exposure to risk is half the time. Okay. Now, I say buy options here. I'm talking about a swing trading outlook, but you can buy options intraday, just to trade within a 5 or 10 minute time frame, or a chart, 5 or 10 minute chart. No problem. Monday, Tuesday, Wednesday, Thursday, Friday. It doesn't matter. No problem. Good question, Yato. Commissions justify weekly trades. They're actually, because we are buying and selling credit spreads, or commissions do come into play, because when you sell a spread, you actually incur twice the amount of commission as if you're just buying a call or a put. But the point is when you do sell these credit spreads, you don't have to buy them back. If we have a good trade and we get to Friday and this thing expires worthless, you don't have to buy it back, and the trade automatically closes. The only time you get paid, you have to pay a commission on credit spreads, is when you actually buy them back. Now, keep in mind, that's the cost of doing business. Credit spreads are not very intensive in terms of managing. So it is the case that you could, managing getting in or managing getting out, you could probably go with a very low commission broker for that. How does theta decay help with buying options? CE, actually they don't. They don't, because what you're talking about is when you buy options, you want to mitigate as much of that time decay as possible. It's like buying a car. As soon as you drive a brand new car off the service lot, off the sales lot, the value of that car is worth less than when you just drove it off yesterday. So basically what you need to do is either utilize the leverage of the options and make enough money to offset that time decay, or you're in the, like we do in our live trading room, we are in those options for a relatively short amount of time, so that time decay does not affect the options. There are other strategies by using debit spreads or a little bit longer term options that are maybe 2 to 3 weeks until expiration, but in general we try to be in and out of them and use them well. The delta also comes into play. We try to buy in the money options, delta 70 or better, because they have value other than just time value. In the money options tend to hold their value longer. Why buy options? Well, there are other strategies in general, CE, that we use to buy options. If we have a setup that has an explosive move coming maybe in the next day or so, that's when we buy options, because the leverage of options really comes into a play when you're buying directional. Okay? If we're selling credit spreads, when we're selling credit spreads, it's more an income strategy. I have to learn how to write with a mouse. Okay. All right. Raymond, Vega. I can talk a little bit about Vega, but if you let me get through this part, I'll answer it in the next section of questions. All right. Well, actually, there we are. So again, time decay is probably the most important factor in the two trades that I'm going to show you coming up. And then how we schedule them on a weekly calendar is also very important, because you want to balance the time of risk. You don't want to be exposed too long, but you want to have enough time premium in there that you sell that you can actually get paid. So you're balancing profits and the amount of time that your exposure to risk. Okay, that's why the calendar comes into play. All right. Hi, Ramadeep. Yes, actually, that is a very good function. Also, it depends on how much premium do you try to collect every week, and how much time. A lot of that comes into play based on how aggressive you want to be. In the live trading room, when we do these every week, we try to be conservative, but we take advantage of setups based on price action and momentum, so that we can we tend to mitigate risk more so than try to boost profits. But again, you'll see that there's some strategies that we use that we actually benefit from both. Okay. All right. Let me just see here. The other question that someone asked was Vega. Now, I did not speak about Vega too much because it does come into play, and it's a very good question for implied volatility. Again, Vega is the Greek factor that is affected by volatility. Okay? And volatility is basically the way the underlying stock moves both up and down on a daily chart. Okay, if you're talking about something like Tesla, okay, you can see Tesla can move up and down 2, 3, 4, 5% in a day. Then we talk about something like General Electric. Okay, that might move 20 cents, 25 cents in a day. Tesla has a much higher implied volatility, so it can cover more ground higher and lower every day. So the options on Tesla are relatively more expensive because of high implied volatility compared to General Electric and GE, because it doesn't move as much. Then its options are much lower in terms of implied volatility. Okay? I'm just trying to be deliberate, Eric. So because I have different levels of people in the room. The day after the earnings release, even if a stock goes higher, the calls can go lower. That is, Nissa, that's a very good question. And what happens is, because of earnings, normally what will happen is the implied volatility will, when a stock has a date on the calendar that earnings are released, the value of those options basically double before the earnings release. After the earnings release, the value of those options basically drop because the implied volatility basically gets cut in half. Okay, so regardless of which way the stock price goes, the implied volatility is going to contract almost by 50%, and that is why options really deflate. Okay, so even if you are correct, if you bought the options right before earnings, they're inflated. And then after earnings, the balloon gets cut in half. So even if you are right, there's a good chance that you're not going to get paid as much. Let's just see here. Good questions. Good questions. What is my opinion on weekly versus monthly? Yado, I think they both have good aspects to them. I prefer to trade the weekly because I like to get my options moving in the direction of a quicker time decay. Sandy, good question. When you're trading in the money options and the delta gets closer and closer to 1, it becomes more and more like the stock. But you also have to keep in mind that that particular option is still much more leveraged than the underlying stock. So you still trade it like the stock because you're trading based on what you see on the chart of the underlying stock. But you always keep in mind your profit is based on how much the option goes up. John, I don't know if I'm going to be able to get into gamma. That becomes a little bit outside of what we're talking about. It tends to affect things longer term, just like the longer term Vega. Nick, sometimes we do, sometimes we don't. It just depends on the stock. Celso, we don't really talk about binary options. No. All right, so let's just go ahead and move on to the actual strategies that I want to talk about. Again, utilizing the Greeks that we were talking about just a couple of minutes ago. First of all, again, I've alluded to this particular strategy of selling credit spreads. Now, when you sell credit spreads, what we're looking for are high probability trades. Okay, because we sell these credit spreads on the weekly, we have what we basically amounts to a swing trading focus. We are looking on the daily chart, but we are only looking out 2 to 4 days. Okay, again, daily chart is the chart that we use. What we are trying to do when we get into these trades, we're trying to currently evaluate the momentum strength of the current movement of the stock. We're trying to get the direction, and we're trying to identify good support and resistance levels, whether they are EMA levels or distinct inflection points. Okay. Now, what we are trying to do with this type of trade is we are not trying for a home run. Okay, we don't want to sit here and look for something that'll go up 100%, 200%. What we're looking at are what we refer to in baseball parlance as singles. Okay, we want to make sure we can earn anywhere from 3 to 8% per week for the money that we commit to this strategy. Now, that may seem like a lot in general when you're looking at a mutual fund, but you keep in mind that there is some commission costs involved, but anywhere from 3 to 8% makes a big difference in your trading portfolio over the long term. So again, it is a long-term investment growth that we're looking for. Right now, when you guys are used to looking at stock charts and you're always looking to see which way is this stock going to go, is it going to go up or down? We actually look at it from a different point of view when we're selling credit spreads. What we're trying to do is we're trying to sell away from the projected price direction. We want to know where prices are likely not to be at expiration. So we're looking out 2 to 4 days and say, where are prices not going to be? Okay. Now I will show you, I know I'm showing you a lot of text. I will show you on a chart, but I want you to understand that the underlying is, the underlying premise of this strategy is to look where prices are not going to be, and that is where we're going to sell our credit spreads. Now, how do we make money on this? Basically, we are selling a premium and we're hoping that we don't have to pay it back. So we want profits to come from the value of the credit spread that we sold will decrease when the price moves away from the short strike. And then again, another important factor is theta, or time decay. And basically the options that we sold are out of the money, and we want these things to go to zero. That's where we get it, zero. Now, it gets to the point where we understand that we have a maximum amount of profit we can get every week. If by Wednesday or Thursday we realize 80 to 90% profits, it doesn't make much sense to keep the trade on and expose ourselves for another day or two in which we may lose that profit. So what we will do is go ahead and buy back the credit spread for, if we sold it for $1, we're trying to buy it back for 10 to 20 cents. Okay, we want to risk time exposure. Why don't we use a debit spread versus a credit spread? Now, there are opportunities where we use credit spreads, John, but this particular strategy is, in essence, we're trying to collect premium, because it is and you'll see it on the chart here, it is a much higher probability type trade, because in essence, let me work through it and then you'll see why it is the case. All right. So when we're trading Google, please excuse this is a little older chart, but the example is the same. When we're looking at the price action in Google, what we see here is this first low, and then we see the histogram profile here, and then we see the second low right around 845, and we see the histogram profile here. It's much weaker, so this is actually a bullish divergence, and it starts to move higher. Now, if this is Tuesday and we're about to get into a trade, the first question we ask is, when we evaluate, we see which way Google is going, and Google is obviously going higher. We can see the price action, we can see momentum here is nice and green. Our indicator line is going higher also. Again, this is value charts, and these are MQ momentum. This is value bars. We can see the value is increasing. So we know and we feel like we have a good idea that Google is going higher. When we sell a credit spread, the first thing we look at is where is the price most likely not going to be in the course of the next 2 to 4 days. And chances are it's not going to be here. Do you see where I put that star? Right there. It's not going to be back below the 485 level. I'm sorry, 845. It's still early in the morning for me. 845. So we think that the price is going to go higher. So we say the price is most likely not going to be back down here. And this is where we sell our credit spread. We will sell the 840, 835 credit spread right in here. It's a $5 wide spread. Okay, we can usually get anywhere from 20 to 40 cents premium per spread, which is $20 to $40 on a $500 investment. Okay, it doesn't seem like much, but it's anywhere from 4 to 8%. Now, the reason why we don't necessarily buy debit spreads is because, again, a debit spread is a depreciating asset, so we're losing money even if it does go our way. But the thing about the stock price, if it's going higher, then this is the current price. Stocks can go straight up. They can go at a 45-degree angle. They can go sideways. Okay, and that way debit spreads don't make any money. It could even go down a little bit. Even if it goes down a little bit, the only one factor that we do not make money is if it goes directly down. So 4 of the 5 potential moves in Google, we make money. Okay, this is the only one in which we have the potential to lose money. And again, the reason why it's high probability is because this is where the current price is here at 878. Our short strike is at 840. So the value of Google actually has to drop nearly $38 before we can lose money. Okay, and yes, if it does go against us, we can make adjustments. That's not a problem. But usually we don't make adjustments. We monitor our risk reward. If it starts to go against us and it's early in the trade, we'll go ahead and take the loss. But we don't wait till it's down here. We have certain parameters in the room that we follow that keeps us out of trouble. But the majority of the time, I'd say greater than 90% is our track record for this year, that we actually don't have it go against us. When do I enter? We usually do this on a Tuesday. And then we look to hold until Friday, but we can get out sooner if the trade goes in our way. Okay? But that is the credit spread strategy to the upside. All right? Again, that's utilizing value bars and MQ momentum. It helps us determine which way is the stock going, and then we turn our eyes the opposite direction and say where is the prices are not likely to be, and 840 is the level that we pick. All right, let's do another example so you guys can see that. All right, here it's Tuesday. We're looking at the price action. Look at momentum down here. It's obvious that we have downside momentum and it's actually increasing to the downside. You can see the price action. It's also going down. Now, at this point, Trevor, we do consider implied volatility from the standpoint of when we're picking the stocks that we're selling credit spreads on. We want to pick stocks that have a generally high relative implied volatility. That way we can get more premium. All right, so in this case, CMG on a daily chart, CMG is already falling. So the next thing we say, okay, it looks like CMG is going to keep falling. Okay, if we're looking at this, we'll say, okay, where is CMG not likely to be over the next 2 to 4 days? Okay, so we look at the price chart. Here you have the 8 EMA crossing the 21 EMA, and we have all this level of support. Now, to be a little aggressive, we can say that the prices probably won't be around 530. If we want to be a little bit more conservative, we can say, well, they probably won't get above 540. Why? Because they've been in this sideways channel until the breakdown lower. Okay, so anywhere from 530 to 540 is where we can sell the short strike of our credit spread. Let's just say we picked 540, so it would be 540, 545, a $5 wide credit spread. And again, we're looking anywhere from 20 to 40 cents. Okay. Now I'm giving you just the idea of how we pick these credit spreads. We actually go into much greater detail when we're looking at the various support and resistance levels, different time frames, etc. But the idea of a bearish call credit spread, okay, is we're selling the premium based on the fact that we don't think prices will be here in the next 2 to 4 days. Again, because of what momentum's doing, because of what value charts are telling us. Not necessarily, Richard. Does this only work for high-priced stocks? No, John, it doesn't. It's just harder to implement on cheaper stocks because you don't have as many of the strikes. On CMG and Apple and previously Google, we have $5 increments, divisions on your short strike. Okay, but with something like General Electric, which may be trading for $30 or $40, you may not be able to pick the particular levels that you want. But the strategy is basically the same. It's the implementation of it and how you carry out where the short strikes are. That's where you could run into some issues. Okay. All right, so let's just keep going because I do have another strategy that I want to show you. Again, let me give you this example. Here's Tesla. Here's this is the setup. Here's the first high. See the strong upside momentum. Here's the second high. Basically what this is a bearish divergence. So we actually think that the price of Tesla is going to fall. Okay, see downside momentum is picking up. So the question is based on this price chart here, where do we think prices are not going to be? And those prices are probably not going to be revisiting $190 in the next 2 to 4 days. So that's where we put our short strike, above this second high. Okay, so momentum is carrying the price away. The price action setup, the bearish divergence is carrying prices away, so that it looks like 190 is a safe level to sell a credit spread. And again, same strategy, $5 wide credit spread. Try to collect anywhere from 20 to 40 cents. Sometimes you can be a little bit more aggressive depending on how the move is. Try to collect more premium. All right, so again, just showing you anywhere from, we're talking 4%. Hold on. All right, so anywhere from 20 to 40 cents per week. That is anywhere from 4 to 8% return per week. Now, the reason why this is important, this is a weekly strategy. Now, I can't promise you're going to do this, but from a 4 to 8% return on the money that you commit to this strategy, let's just be conservative and say, well, okay, after commissions, we're talking 3%. Do this every week. That roughly equates to like 12.5% per month. Now, if you start out with $10,000, you carry this strategy for an entire year, you're talking about, with reinvested gains, you're talking with a compounded return of $10,000 going to $46,000. After 2 years of the same general strategy, that should, based on the calculations, grow to something above $200,000. You can say, Dave, is that realistic? Excuse me, one moment. Apologize for that. Is that realistic? I think based on the strategy and how we've been carrying it out in the live trading room, this type of return of looking for 20 to 40 cents per $5 wide credit spread is very doable, and we do it with a very conservative strategy. We also do it with very conservative stop loss levels. Now, let's just say you're conservative in the way you implement this. Your $10,000, instead of going to $46,000, goes to $30,000. Okay, that's still a triple, and then after the second year, you could be close to $100,000. I can't show you any particular numbers. I can't promise you numbers. What I can tell you is people in my trading room do this very consistently. You can work out the numbers. I actually invite you to visit my trading room and help watch us implement one of these strategies over the course of a week. Subakir, that isn't your question is wouldn't one bad trade wipe out 10 winning trades? Yes, it would, but we actually limit our risk to if we're going to earn 20 to 40 cents per contract, or $20 to $40 per contract, our max loss in each trade is twice that amount. So we will be willing to take a loss of anywhere from 40 to 80%, 40 to 80 cents per contract. Okay. Now, what you're saying is with a $5 wide spread, it would wipe out a lot of our gains. If we limit our risk to anywhere from to 2 times the maximum credit received, we can very easily manage that risk. It slightly lowers our success rate because we tend to get out of trades a little bit sooner and have them like they could go against us just temporarily, and then they shoot higher like we assume, and then but that's just how we control risk. Okay, we would much rather not risk losses and then just have break even for one trade, and then a couple of other spreads make money. That's not a problem at all. Again, I'm showing you 20 to 40 cents per credit spread. That's 4 to 8% a week. The numbers that I just put up here on this chart, I'm talking 3. Okay, I'm talking 3. So if you had 4 trades and you got stopped out of one break even, and then the other ones made money, and you just average 3%, you can extrapolate whatever you want based on how that account can grow. Ramadeep, very, very successful. I think over the past 4 months, we probably had 2 that went against us, and then a couple that we got stopped out at break even. Do I use delta to determine the short strike? No, Nick. Our strategy is based on what we can see. It normally rolls, our short strike usually runs anywhere from a delta 10 to a delta 15, sometimes delta 20, but we don't base it on pure deltas. We base it on what we see with momentum and our chart, or with value charts and value bars. Okay, let me show you quickly this last strategy. It is based very similarly to what we do with credit spreads on a weekly basis, but I'm running out of time here, so I want to make sure you can see this. This is a new strategy that we've really started implementing in the past 6 weeks, where we sell a lot of volatility premium. It's exactly the same as the credit spread strategy I just showed you, but what we are using is instead of like a stock like Apple or Google, we're actually using the VIX, or the S&P 500 index volatility index. All right, and the VIX is based on the aspect of volatility of the S&P 500, in which when there is fear in the market, when there's uncertainty, or when the price of the market is actually falling, it actually causes the VIX to jump higher. Okay, what we do in order to trade the VIX, we use a VIX ETF that enables our trading. And very similar to what Brad was talking about earlier, we actually trade the ETF to capture the movement of the VIX. And we actually utilize a leveraged ETF to do that. That gives us a very high implied volatility. Now, we utilize, again, the same credit spread strategy that I showed you earlier, but in this case, we only sell the bullish put credit spreads. I'll explain why, but we only sell the bullish put credit spreads. Okay? We do not sell the opposite side. We do not sell the bearish call. Okay? The VIX, and the reason why we do that, the VIX is much more likely to spike higher and grind lower. Again, the market is easily scared. Talk about stuff going in the Crimea. Janet Yellen says something about raising interest rates maybe 6 months from the time they stop quantitative easing. Those things scare the market, and it causes the VIX to spike, even just over small periods of time. Now, the VIX has a tendency to grind lower when the market is making steady gains higher. Okay, so it's grinding lower when the market goes up, but when the market goes down hard, the VIX will spike hard to the upside. We don't like those spikes. That's why we sell bullish put credit spreads, because if we take the opposite side, we can get caught with a spike going against us, especially if something happens bad in the world. Now, again, what we're trying to do, how's the audio? You guys can hear me okay? CE, what you may want to do is test your sound. Okay, everybody else is okay. All right, now when we're selling this volatility, we want to, again, we have the goal of weekly profits. Again, utilizing a VIX ETF, and specifically it's UVXY. Now I'm just going to give you the parameters and I'll let you play along with this because I only have a couple more minutes. But again, we are selling credit spreads, bullish put credit spreads, and we are selling them when they have about 2 weeks from expiration. Okay? 2 weeks. So anywhere from 6 to 9 days until expiration. Now, the reason why we like to use UVXY is because it has a very high implied volatility. It's usually about plus 100%. Okay? Because it's leverage. It's a 3 times leverage stock. Now, here's what we've been doing in UVXY for a while. We've actually been selling a lot of credit with the short strike right around 55. This is yesterday. Spiked higher. Now, I can basically say that we've been doing it very consistently, been making money, and here are the big spikes to the upside. See this 3-day spike up? Okay, this spike higher here. Back here, this spike. This is when they invaded Crimea, right here, that spike higher. You don't want to be bearish, okay? You don't want to be bearish UVXY because it can grind lower and you can manage that, but when it spikes higher like this, it's very hard to manage. So we like to do it from the bullish side, okay? Right now, making a lot of money. And roughly the types of return we're getting, we are just recently doing a $2 wide credit spread. And in general, we get anywhere from 50 cents to 80 cents. Okay, just recently when we were down here, I was getting $1.10. It's a $2 wide credit spread, and I'm getting 50 to 80 cents. That's anywhere from 25 to 40% return on that credit spread of the amount that I put in there. Okay, so keep that in mind. It's a $2 wide spread, and earning anywhere from 50 to 80, and this is per week. No, Ken, not in the trading room. Okay, so again, take what I said about the credit spread strategy and apply it to UVXY. Actually, what I would suggest is this, because I'm out of time. Just keep in mind that this is just one of the strategies that I'm going to be talking about in my weekly, it's a weekly power options strategies workshop. I'll be holding it about a week and a half from now on May 6th. It is from 6 p.m. to 9 p.m. I'm going to talk about all the Greeks in detail. Volatility premium will be one of the prime strategies I'm going to be talking about, and then some swing trading, again with debit spreads. I know some people asked about that, talking about more candlestick type reversals and trading option credit spreads with those reversals. Eastern time, Eastern Daylight Time. Okay. All right. Now I do have a special offer for you. If you want to see us trade these options, we have a $7 special for the next 30 days for people on this call right now. If you go to valuecharts.com/go, okay, you will be able to sign up for our platinum membership, and this will give you full access for 30 days. And it's a great, if you're interested in any of the strategies I talked about today, my suggestion is especially that credit spread premium one. Sign up for the trial offer and come sit with us just for an afternoon on Tuesday afternoons, because those are only for members. And we can go in there and you will see us get into these credit spreads, see us manage these credit spreads for the rest of the week, but also that UVXY. Okay, I'm telling you, that is an amazing trade. I actually have 40 credit spreads on in UVXY right now, earning anywhere from the 80 to $1.10, and it's moving our way now. So come in, learn more. $7, that's almost nothing for just the opportunity to learn these particular trades, and you can have fun too. If you're interested in value charts themselves, go to valuecharts.com/chart, and there's a free, there's a limited to offer of $97 for our value chart indicator. So that's valuecharts.com/chart. But this is what I'd like to see you guys really take advantage of. Again, $7 for the first 30 days. After that, it's not $197. It's actually $97 per month. And we have people that make that up in the first trade.
Today we're going to be presenting in our presentation the 3 key elements of a winning strategy, and these are actually the components of a strategy that I will be sharing with you, just the basis of it. For those of you who haven't seen me speak before, my name is Stephen Primo. I am the president and founder of Specialist Trading. First and foremost, Specialist Trading is an educational company. Even though I provide you with all the insights and wisdom and trading strategies, as you see here, from the floor, we're really about teaching you how to implement this within your own personal trading, and then empowering you so that you can make the decisions for yourself, so you can actually become a part of the process, as opposed to what so many traders do, rely on an outside source to tell them what to do. To give you a little bit of background about myself, I've been trading for roughly 37 years. I started my trading career on the floor of the Pacific Stock Exchange. I was on the floor for a total of 16 years, and 9 of those years I was a specialist for Donaldson, Lufkin, and Jenrette. That's where we get the name Specialist Trading. Now, there aren't a lot of specialists around, so for those of you who really don't know what a specialist was, if you ever look at the pictures with the people trading on the floor and making the hand signals and all the paper on the floor in front of them, a specialist was the person behind those large wooden booths, so that if you wanted to buy or sell a particular equity or a stock, you had to go to the person who specialized in those stocks, and the specialist had anywhere from 30 to 50 equities that he specialized in. So I did that for roughly 9 years on the floor. I traded through the crash of 1987. I traded through the great bull market that followed after that, and I've seen and been through just about every market environment imaginable that you can think of: straight up markets, straight down markets, sideways markets, quiet markets, and I've seen and traded just about everything there is. I left the floor in the mid-90s to manage money and to also pursue my own trading, and just about 6 years ago I started Specialist Trading, where I just teach and mentor my students all of the things that I've accumulated in my 37 years. I know a lot of people are struggling with their trading today, and so rather than have to go through 37 years of knowledge, hopefully we can shorten your learning curve so you can learn all the things that I've accumulated in just a really short period of time. So as I stated, we are first and foremost an educational company. We empower all of our students with everything I've accumulated. And before we begin, I just want to share with you our disclaimer. We're required to show you this. I'm going to show you a lot of performance results using these 3 key elements, but please remember that we can in no way guarantee that any of the results I'm about to show you will be repeated. So as you're taking a view at our disclaimer, I'd also like to mention that I love to take questions, but for those of you who have been to my presentations before, I like to save them for the very end. I kind of like to present as if we're in a classroom. So if you have any questions, please write them down, and I promise I'll get to them at the very end of the presentation. But many times, if you kind of hold off for the next slide, your question will be answered. And the webinar seems to flow a lot smoother if we wait till the end. So if you have a question, just write it down and try to remember it, and I promise I'll get to it at the very end. Now, I'd also like to invite all of you to become members of our Twitter following. You can follow us there at the name given below, at Specialist Trading, the abbreviation there, SPCLST-TRADG. We post a lot of great information, free information. We post signals that we're currently in stocks, the futures, and in Forex. In fact, we posted a signal in the QQQ for Monday, so you may want to go there and see exactly what it is. So we invite you to follow us at Specialist Trading. Okay, now before we begin, I just want to share with you a little bit of my experience. I know a lot of people will think that, well, because you were on the floor and you had that special insight and that extra edge, you were able to make money hand over fist. And that's not really true. In fact, my first year or two as a specialist, I didn't think I had much longer of a time to be in the business, because I really couldn't make ends meet. I couldn't seem to get going in any level of consistency. I would have 3 or 4 great trades, and then I'd have one trade where I gave everything back. And so it was really very discouraging. I didn't know if I was going to be able to make it as a trader on the floor, and I thought my days were numbered until I came in contact with my own personal mentors. These were specialists themselves who saw that I was struggling, and they taught me how to trade with the specialist edge. And they said, Steve, basically the reason why you're failing is because you're overcomplicating your trading. You're following far too many indicators, putting too much reliance on news and newsletters, and you really need to focus on what's in front of you, the chart that's in front of you. So what they really taught me was that the more overcomplicated your trading plan is, actually, we've been taught that that will make you more successful. It's actually the opposite. They said that the simpler you make your trading plan, the more you'll get on that road to success, and success is really just about consistency. It's not about hitting home runs or making tons of money, because I knew traders on the floor who hit home runs, who made thousands, if not hundreds of thousands of dollars in a relatively short time. But I can honestly say that none of these people who made all that money are trading anymore. And in fact, most of them are wiped out. So their trading plans couldn't sustain them. So it's not so much about hitting a home run, it's about having that consistency in your trading. In other words, 2 steps forward, 1 step back, well, you'll be able to trade another day, 10, 20, 30 years down the road. And the way we get to that through the Specialist Edge is through keeping things as simple as possible. So that's what I want to share with you today. These 3 key elements are extremely simple. In fact, I'm sure most of you have heard of them before. It's just that you weren't able to implement them correctly or to add them properly to your trading plan. But the same thing my mentors taught me is what I teach to all my students, is that simplicity equals consistency. And that's what we're looking for. From time to time, our strategies and techniques will hit home runs, but we're more about getting that single type of trade where we have nice little golden nuggets here and there that add up over the long haul. Okay, so remember, simplicity equals consistency, and consistency is really what it's all about. All right, so here's what you're going to learn today. And remember, once again, if you just joined us, I will not even open up the question and answer box, so I'll look at all your questions at the very end. So if you happen to write a question in your little box there, I'm not even going to see it. So just wait till the very end to ask any questions, and I promise I'll get to them in just about a half an hour or so. Here's what we're going to cover. Here's what I'm going to teach you today. I'm going to teach you these 3 keys. The first key is trading in sync with the market. I know all of us want to trade in sync with the market, but we have a very difficult time doing that. I'm going to teach you a very simple but powerful way in which to do that. Then I'm going to share with you key number 2, which is a specific price bar pattern that will really amp up your levels for success and really give you that increased chances for having a successful trade. And then once we put the keys 1 and 2 together, we're going to show you a specific entry technique that you can use for any strategy or any type of trading plan. Now remember, all of these keys are not a full-fledged strategy. They are just pieces of the puzzle, very important pieces of the puzzle that make up a strategy. But you can add them to any current trading method you're using now, or any current trading plan. Or, as you'll see at the very end of this presentation, we use these 3 keys, these 3 elements, to make up probably one of our most consistent strategies of specialist trading, and that is strategy number 4. So I'll share with you a lot of trade results that happened just as early as yesterday, some trading results, trading the market using strategy number 4. And strategy number 4 incorporates all of these 3 things which I'm teaching you today. Okay, so why don't we begin? Let's start out excuse me, looking from a buy point of view, as if we want to go long, but we have to use these 3 key elements in order to make sure that we're in sync and that we're trading on the right side. So key number 1 is obviously we want to trade in sync with the trend. You've all heard this before, the trend is your friend. You have to be in sync with the market. Now, if everyone knows this, why do the majority of traders lose, or they're out of sync? We feel at Specialist Trading it's because there are 1,000,001 ways in order to be in sync with the trend. Virtually every trading educator, every website has a different method for being in sync with the market. Everyone will tell you, well, it's an indicator, or no, it's a specific news event, or it's looking at long term as opposed to short term. Everyone has a different way of looking at it. And remember, as I stated in the very beginning of this presentation, the reason why, in our opinion, most traders lose is because they overcomplicate their trading. Now, let's look at this example here, this generic chart. Really doesn't matter what market it is or what time frame. This is just for educational purposes. But we want to, look at this chart, and just off face value, someone would say, well, Steve, there's no real trend here. In fact, this is a rangy market. I can just tell right off bat because nothing is happening. We have this kind of range. We're going down, and then we go back up, and then we go down again. So I would stay out of this market. There's no real clear-cut definition of the direction of this particular market. Well, at specialist trading, that's not true. We have our proprietary overall trend identifier, and that is simply the 50-period simple moving average. That's all it is. I want you to plot a 50-period simple moving average on any chart you have, regardless if it's a 5-minute chart, if you're an intraday trader, or a monthly chart if you're an investor. It doesn't matter if it's the Forex markets or if it's the stock market. You should always have a 50-period simple moving average plotted, and then you ask yourself, where is the majority of price in relation to that 50-period simple moving average? If price is above, as it is in this case, well, then the overall trend is up. That's how simple it is. You see, you don't need to look at the higher time frame to discern what the lower time frame is. You don't need a ton of indicators or neural net or all these convoluted ways of discerning what the trend is. Just plot the 50-period simple moving average. And if the majority of prices are above, well, then the overall trend is up. That's it. That's how simple it is. All right, so that was key number 1. Key number 2 is we want to look for a bar that closes in the top 25% of its range. So in other words, if you take the range from the extreme high to the extreme low of the bar, remember, regardless if it's a 5-minute bar or a monthly bar, you want to see that it closes in the top 25% or the top quarter of that bar. All right, so looking at that exact same chart, excuse me, we know that we're in an overall uptrend, and we want to find those bars in this overall uptrend that closed in the top quarter of their range. And those are these 3 right here. Okay, this is the pattern we're looking for. All right, key number 3 now. First of all, let me just backtrack to key number 2. Let me just go back here and show you. The reason why we're looking for this pattern is because the market is giving us a clue as to the short-term direction it wants to go. Remember, not an outside source, not some guru that you see on TV or some book you've read, but the market in real time is telling you that most likely it wants to continue in the same direction. So if it closes in the top 25% of its range, most likely it's going to continue in that direction. This is a fantastic clue that the market itself is giving us. Okay, now let's go to key number 3 now. If we want to put keys 1 and 2 together, how are we going to enter? We're going to enter upon the confirmation of trend. So what exactly does that mean, the confirmation of trend? Well, what it means is, you may want to write this down, or don't worry, we'll go over and look at a lot of charting examples. This means that you want to buy, but on the next bar only, if price trades 1 to 5 ticks above the bar that closed in the top 25% of its range, in the top quarter. So in other words, these bars here that we have in green, we showed you earlier, we want to go long if they trade above, 1 to 5 ticks above the high of these bars here in green. These are the ones that close in the top 25%. But it has to happen on the next bar. Why? Because we're trying to catch momentum. We want to see that the momentum has continued in that direction. If it doesn't go above on the next bar, as in this example right here, well then there's no type of trade setup. As you can see, it didn't. Momentum didn't continue, so we didn't do anything. But guess what? Right here we had another bar close in the top 25%, so we want to see it on the very next bar trade above, and it did. And look what happened. We would have entered, and a nice rally continued. Not a lot, but at least we knew it was going in that direction. And we had a third example right here, where we closed in the top 25%. So this is where you'd want to enter, but only if it traded there on the next bar, regardless if it's a 5-minute bar, a daily bar, a weekly bar, a monthly bar. It doesn't matter. And you would have entered. Even though we didn't close there, it doesn't matter where the close is, just as long as intra-bar it trades above there, you would have entered. And guess what? The market gave you a clue as to its short-term direction and went straight up. See how simple it is. We didn't have to rely on an outside source. The only thing we're relying on is the market giving us clues as to what it wants to do. And then we just simply jump on board. All right, that was looking at it from a buy point of view. What if we want to go short? We simply take the same key elements and we turn them upside down. So we also must be in sync with the trend if we want to sell. Now, once again, looking at this chart, someone would say, well, Steve, there's no trend here. We're just basically going sideways. Not true, because you see, we're going down and then up, but we haven't added the 50-period simple moving average. So if we add the 50-period simple moving average, we ask ourselves, where is price in relation to that? Obviously, price is below, so we are in an overall downtrend. It doesn't mean we're going to short at the market. It's just telling us that the overall trend is lower. That's good to know. All right, so now we're in sync with the market. Now we want to look for key number 2. These are bars that close in the bottom 25% of its range. So if you have a bar that is high as 51 and the low is 50, you want to see it close in the bottom quarter, 50.25. You want to see it close in the bottom 25% of its range. So if we look at these bars right here, we see that we have around 4 of them that closed in the bottom 25%. See that? Now this bar closed lower because it's a dark candlestick, but it didn't close in the bottom 25%. That would have been somewhere around here. This bar closed lower, but it closed in the top 25%. We're not interested in bars that are closing high because we're below the 50 period. So we see that these 4 bars closed in the bottom 25%. They're giving us clues as to the short-term direction of the market. And now key number 3, how do we enter if we're putting these all together in some type of strategy? Well, we're going to use that confirmation method again, and that simply states that we're going to go short or sell on the next bar only if price trades 1 to 5 ticks below the bar that closed in the bottom 25% of its range, or the ones we just colored red. So as you can see here, if we go down these bars, we closed in the bottom 25%, and there really wasn't a lot of follow-through. Even though we drifted lower, there wasn't a lot of follow-through on the first of these. But that's okay, you know, applying a proper money management to some type of strategy. Remember, these are just elements or pieces of the puzzle of a strategy. They aren't the full-fledged strategy yet. We're just showing you how to be in sync with the market, what to look for, and how to enter. We still need to know about money management. We still need to know about exits, and those are other elements that we'll discuss in another webinar. But as you see here, we have this particular bar, once again, that closed in the bottom 25%, and you would have entered on the very next bar right here. Remember, we're not interested on where it closes. We're only interested that intra-bar we trade 1 to 5 ticks below. So it met the requirements, so we would have entered right here to go short, regardless of where it closed. And then look what happened. See how the market gives you clues as to what it wants to do. But we're too busy trying to overcomplicate our trading and trying to look at far too many indicators, follow far too many speakers and educators, and read too many, much information and too much news. And it just serves to overcomplicate our trading. And remember, what my mentors taught me really still holds true 37 years later, is that the more complicated you make your trading, the less chances you have for being successful. If you look at traders who have been trading for 3, 5, 10 years, most of their trading plans are pretty complicated. You have to study them a lot. But if you look at traders who have been trading for 20, 30, 40 years, most of their methods are simple. They have maybe 3 to 5 rules, and that's it. So this is extremely simple. We're sharing with you the basis for a very, very sound trading method. And one of the great things is that you see here all of these bars continued to close. Many bars closed on the bottom quarter of their range, and you could have sold more if you'd like to. You could have sold into this sell-off. So we just shared with you 3 of really key elements of any trading strategy. You can put these together and make your own trading strategy based off of what I just shared with you. You can add these to a current strategy that you have, and I really feel strongly that they'll increase your odds for success just by adding these things. But you can also trade strategy number 4. Strategy number 4 is probably our most consistent and popular strategy at Specialist Trading. It incorporates all of these 3 elements and a couple more. And we shared with you the majority of them, but let me tell you a little bit more about strategy number 4 and some of the highlights. It's for basically all traders, from beginners to advanced. Strategy number 4 is traded in over 60 countries around the world. We've marketed it all around the world, and it's been traded right now in over 60 countries. And it's traded from anywhere with people who are hedge funds traders to people who have been trading for maybe a couple of weeks. The exact same rules. Nothing has changed for someone who's been trading 30 years as opposed to someone who's been trading 30 days. They're using the same rules. Okay? It's for traders who are looking to catch quick momentum moves. All right, that even though its basis is looking for a quick momentum move, we show you ways in the course in which to extend your gains if you'd like. Now, the intensity level of this particular strategy is a level 2. In other words, if 1 is the most intense, meaning that you have to virtually watch every tick, you have to be glued in front of your computer at all times, and 3 is the most relaxed, where you can just basically place your orders in and walk away. Well, here we're right in the middle. It's a very simple and easy, orderly strategy to follow, probably a very moderate intensity level. It only uses 1 indicator. We shared that with you already. That's the buy-sell line, or the 50-period simple moving average. That's how we determine the overall trend. And that's the only indicator it uses. All right? You can use this on any time frame, any direction, and any market. So I don't want you to think that, well, Steve, I don't really trade stocks, or I don't trade E-minis, or I'm not an intraday trader. It works on virtually any time frame. If you're an investor and you look at monthly charts, you will see signals on monthly charts. That's how good this trading strategy is. Now, I'm not going to sit here and promise you that every trade is a winner. Excuse me. That would be, it wouldn't be fair, and that would be fraudulent to say that, because I don't believe in that. I've attended presentations in the past where people have told me this strategy or system makes 1,000% a month, and it scares me to hear that, because I know from trading for 37 years that nothing works that way. You're bound to have losers every once in a while. Think of any athlete, think of any performer. Nothing is always 100% fantastic. Everyone goes into some type of slump, or everyone goes into some type of drawdown. And even though this is very consistent, from time to time you will have small losses. The point is, we're all about consistency. I stated this at the very beginning, and this is what my mentors taught me, meaning that we want this approach where it's 2 steps forward, 1 step back. 2 steps forward, 1 step back. From time to time, you will hit tremendous home runs with this strategy, and that's great. But we're really looking for having this edge where we're in sync with the market, and we're just jumping on board with what the market's doing for a quick momentum trade. Okay? So let's look at some examples of strategy number 4 for stocks. And remember, they incorporate all of the elements I just shared with you. So we'll see exactly where we are in relationship to the 50-period simple moving average. We'll see where the actual charting bar closed in the top, or 25% of its range. And then we'll see exactly how we entered using that confirmation technique. Okay? All right. Once again, if you have any questions, just wait for another 15 minutes or so, and then I promise I'll answer all of them at the end of the presentation. Let's look at some current stock examples going back from the beginning of this year to as early as just maybe last week. If we start off, we're going to be looking at SanDisk SNDK. We see here, first thing we ask ourselves, where is price in relation to the 50-period simple moving average? And it's safe to say that price is above. Okay, so this means we're only looking to go long. Now, if we use the 3 elements we talked about, as well as 2 or 3 more that are involved in strategy number 4, we see here that we had 2 buy signals, one here and one here. You would have entered just when price traded above these particular bars, and look what would have happened. Some very nice trades here, one in February this year and one in March going into April this last month. How about if we look at RIG, Transocean Ltd. We see here right off the bat, where is price in relation to the 50-period simple moving average? Price is below. So you really would not have made any money trying to pick a bottom in this stock. It's really, it's not worth it. Sure, there are some places where it bounced. In fact, it even just bounced 2 or 3 weeks ago. But isn't it more conducive to being consistent when you're in sync with the trend? So if the overall trend is down and continues to be down, because this is a very current chart up until yesterday or this last week, well, then the point is, why fight? Why try to swim upstream when it's easier to have the current at your back? So obviously we are below the 50 period, all right? It doesn't get much simpler than this. The overall trend is down, and if the overall trend is down, we're only looking to sell. It's that easy. There's no question where we have to think, well, gosh, should I buy this or should I sell this? What's going on in the world? What are these indicators saying that the trend is? You don't have to make it that complicated. Just plot a 50-period simple moving average and ask yourselves, where is price in relationship to that? Price is below, then you're only going to be a seller. If you don't like to sell, if you don't like to go short, then move on to another. Market. It doesn't matter. There's a million and one things you can trade. So if we wanted to trade this, we see that we're only looking to go short, and we want to look for those bars that close in the bottom 25% of their range. Okay? If we look here, these were all real-time signals generated using our add-on that automatically generates signals through Metastock for strategy number 4. You can see here, it caught this right at the top. It caught another one here in February, another one in March, and I believe on the 8th or 9th of April, just a couple of weeks ago, another sell signal. That's simple. See, easier to be in sync than it is to try and fight or pick a bottom. And trust me, I'm not saying this to try and preach to you. I'm saying this from someone who has been there. That's why I struggled so much trading, because I was trying to pick tops and bottoms, and it didn't work. It would work 3 or 4 times, and then on the 5th time, I'd give everything back. So there was no consistency in my trading. Once my mentors taught me these simple rules, I started to become consistent. Okay, as you can see, the trend went even lower and continued to go in the direction we wanted it to. How about if we look at Facebook? Now this is a weekly chart just to show you that it works in different time frames. If you like to, hold on for your portfolio, here's a weekly chart of Facebook. Right off the bat, we can see that price is well above the 50-period simple moving average on these weekly bars. So we know that we're only looking for buy setups, okay? And here were two great buy setups, one at the end of last year and then one at the beginning of February. And these were both long signals, and you could have taken advantage as the market continued to go higher. Remember, these are all using strategy number 4. As you can see, they closed in the top 25%. Okay, you would have entered just above. Now, I know a lot of you are probably gearing up to write, well, Steve, where do I exit and where would I have placed my stop? Remember, we can't give away the entire strategy. There are people that have paid good money for this strategy, but we're just sharing with you the basis of it. And VRSN, as we see here, this is a very current chart. I believe it was up until yesterday. And obviously, we are below the 50 period. So there was no reason to even consider going long. I don't care who on TV or what news article you read that you were thinking you should buy VRSN. I would say no, go in sync with the trend. And the overall trend is down, so it's much easier just to go short or to sell. And these were all signals that were generated using strategy number 4. As you can see, the minute you would have entered into these trades, you would have had some very nice gains. And this was a signal, I believe, that was generated just on the 23rd, just on Wednesday of this past week to go short. And already you're making, I believe, nearly 2 points in this trade. And then lastly, we look at Valero Energy, VLO. This is a daily chart. This was a signal that was generated on the 14th. This was on last Monday. All of our members who trade Strategy 4 had the choice to take this trade or not. But as you see, we are kind of oscillating above and below the 50-period simple moving average. But at this point right here, we generated a buy signal. And even though we opened below and we're kind of oscillating above and below, our entry is above the 50 period. So this is a valid signal to go long. And you would have had a nice, I believe, a 5-point gain within the last 2 weeks. This was up until yesterday or so. Okay, so that's examples for stock traders. How about the E-mini? I'm sure some of you would say, well, Steve, I don't trade stocks. I like to trade intraday. I trade tick charts. I trade hourly bars. How does this apply for me? Okay, well, let's look at the E-mini now. This is an hourly chart of the E-mini going back to the 15th, just a couple of weeks ago, less than a couple of weeks ago. All right, it's safe to say that price is above the 50 periods of moving average. So there is no way on an hourly time frame that we're even going to consider shorting the E-mini. The only thing we're going to do is look for buy setups, okay? And if we use the automatic add-on for Metastock, it would have generated buy signals all the way going up. These are all signals that you could have taken going long up until, I believe, the 22nd, which was this last Tuesday. How about going to a smaller time frame? Here's a 10-minute chart of the E-mini on April 9th. Okay, this was just a few weeks ago on Wednesday the 9th. Now, as we see here, once again, we're kind of oscillating above and below, but the majority of prices and closes are above the 50 period right here. And remember, we're looking for bars that close in the top 25% and that meet all of the other rules and requirements of strategy number 4, which I can't divulge this moment right now. But these two were valid signals. As you can see here, we close in the top 25%. We're entering above the 50 period. So you could have, excuse me, taken advantage, I'm sorry, excuse me, taken advantage of strategy number 4 to go long on the 9th, and look what happened in the next 2 hours, okay? And it's not, once again, that you're looking to make these large gains. You could have taken a quick gain and gotten out in each one of these trades. But we're just showing you how simple it is to make those large gains, if you like, once you're in sync with the trend, okay? Now, a lot of people say, well, boy, what about yesterday? Okay, what about yesterday? Here's a 5-minute chart of the E-mini yesterday from the opening till roughly about the end. Obviously, the market was down, but we knew to go short even prior to the opening. Why? Because the 50-period simple moving average was telling us that the majority of price was below. So there was no reason we would have gotten hurt trying to go long yesterday on a 5-minute time frame. Why? Because majority of price was below the 50-period simple moving average. The same concept that works on a weekly chart that I showed you earlier on Facebook works on a 5-minute chart of the E-mini. So You see how simple this is. You just plot a 50-period simple moving average, ask yourselves, where is price in relation to that? And you see right around the opening here, price was below. So there's no reason you would even thought of going long the E-mini until we closed above for 3 to 4 bars. And at this point it started to, but the day ended. Well, now since we're below, we're looking for those bars that close in the bottom 25% of their range and that meet all the other rules. And look at all the sell signals you would have gotten yesterday using strategy number 4. Our strategy number 4 E-mini traders had a great day yesterday trading this strategy. Why? Because they were simply in sync with what the market wanted to do, and they just jumped on board. That's it. And then lastly, you Forex traders. Okay, this works even better in the Forex markets, because the Forex markets, in my opinion, trend better than stocks and the E-mini altogether, because there's so much more money going into them on a daily basis. Here's a current chart of the Australian dollar. And you see the first part of this chart, we were below the 50-period simple moving average. So from this point on, from November all the way into February, we should have been looking for short setups. And we got them. Strategy number 4 gave us 3 valid setups, which each would have made money. But once we had consistently closed above the 50, the way we have right here in February going into March, now we're looking for buy setups. And guess what? Strategy number 4 gave us 4 great buy setups all the way up into April. And if you want to go out in a time frame, in a weekly chart, we're looking at the euro-yen. Safe to say we're above the 50, so this means we're only looking to go long on a weekly time frame, and these were all automatically generated signals to go long. Strategy number 4 on a weekly time frame. All right, so let's recap. What did we share with you today? Remember, we gave you the 3 key elements and components of a consistent winning strategy. Okay? The beauty of these is that you can, decide how you want to use this. If you say, listen, I already trade a strategy that I really like, well, you can add one or all of these or mix and match whichever one you like, and I really feel strongly that they will increase your odds for success. Simply by using key 1, you automatically know the overall trend by adding the 50-period simple moving average. You don't have to, so many traders say, well, Steve, I look at a higher time frame to tell me what to do in the lower time frame, and if it doesn't confirm, if they don't meet each other's requirements, then I don't trade. In our opinion, you're wasting your time doing that, because it's going to keep you out of a lot of trades. It's much simpler just to look at the 50-period simple moving average and trade the chart you're looking at. Okay? If you want to look at a higher time frame, that's okay. There's nothing wrong with that, but it'll keep you out of a lot of trades. Just look at the 50-period and it tells you what to do. It tells you what the overall trend is. Okay? Or you can add key number 2, looking for bars that close either in the top 25% if you want to go long, or the bottom 25% if you want to go short. Let's say you have a strategy that is working fine for you right now, some winners, some losers, but you're happy with it. If you simply add this and tell yourself, I'm not going to enter or get long into my strategy until I look for that bar that closes in the top 25%, I really feel, once again, you'll increase your odds for success. Why? Because you're following what the market is doing. In other words, the market, when it closes in the top 25%, is giving you a great clue that it's most likely going to continue. But so many times we'll buy or get a buy signal, and the market isn't telling us it wants to go higher. It's just because of the formula we're using. But many times it doesn't work, and I'm sure a lot of you have had that, circumstances where you've had a perfect setup. Either it's news or some type of indicator or something, and the market doesn't go in your direction. Wait for the market to tell you that it's getting ready to go, that it's jumped out of the starting gates. Then you just jump on board. And how do we jump on board? By using the entry technique, key number 3. That is, only enter 1 to 5 ticks above your setup bar's high. Okay? Because how many times have you gotten a buy signal and you jump in and it goes up a little higher and then goes straight down, right? Or it doesn't even go up. You buy at the market and it just fizzles out. We want to have that confirmation that it is continuing to go. In other words, we want to jump on board the train once it's left the station. And so that's what we're doing with this. We want to see that price is trading either above to go long or below to go short before we jump in. This is our confirmation. And it's just a great way to fine-tune your entry. Many times this entry technique will keep you out of trouble. So in other words, if you get a buy signal, what you would normally do in the past is just simply buy at the market. But if you use this technique, you'll see that we never went above the previous bar's high, and many times it'll just keep going lower and lower and lower. And because you didn't enter, you saved yourself a lot of money. So this is a great technique for fine-tuning your entries. So you can mix and match, you can add 1, you can add all 3, or you can devise your own strategy based off of this and trade these 3 key elements. Okay, as I stated, we're an educational company. You can see the amount of attention and detail I give to teaching you all of this information in a free presentation. So we really want to elevate your trading so that you can trade at that next level, so you can be at that consistent level, as opposed to joining the ranks of the 80% of traders who mostly lose. Now, the last way in which you can incorporate these key elements is to trade strategy number 4. Okay, as I said, that's probably our premier strategy. Why? Because it transfers over onto all markets. It's our most popular strategy and probably one of our most consistent strategies. So I'd just like to take the last few minutes here to share with you strategy number 4, because remember, simplicity equals consistency. This was what was taught to me. I was trying to always go for home runs, trying to pick tops and bottoms, and it would work until it didn't work. And then I would wound up, at the end of the month with no money, and I couldn't understand why. Once my mentors taught me to keep things as simple as possible, the way I just shared with you, that's what got me on that road to consistency. So that's what we're about at Specialist Trading. That's what we're trying to do. We're not trying to say that you're going to be, buying yourself a brand new home by the end of the year with all the money you're going to make. We're just trying to say that we're really trying to teach you to get consistent so that you can trade 20, 30, 40 years down the road, because that's what it's really all about. So I want to invite you in the last minute here to become members of Specialist Trading by joining our strategy number 4 course. As you see here in this graphic, it says E-mini strategy number 4, but it actually transfers over onto any market and any time frame. You can use this, as we just showed you, on stocks, ETFs, Forex, and the E-mini if you like. Okay. Once you sign up, you get instant course access. This comes with detailed instruction, as you saw, as I just went into detail, but I didn't even go into detail talking about exits, stop placement, advanced entries, advanced stops, advanced exits. We didn't even go into that, and that's all included in the course. We just gave you the basis for strategy number 4. This comes also with signal alerts for daily bars. We provide you for signal alerts for daily bars in the markets you decide to trade. Weekly video trading lessons, archived going back years so that you can heighten your trading and listen to more different and more advanced ways of trading. Also, this comes with the free add-on for Metastock for exploration scan, so that you can scan and look for strategy number 4 setups on a nightly basis. Okay. Also, if you're intraday trading, you will see these buy and sell arrows automatically be generated when a signal appears. So, as we showed you on those intraday E-mini trades. And lastly, you get access to my personal email. You can contact me whenever you like. In fact, before I was speaking today, I was answering emails from my students that wrote me some emails this morning. So I will be in constant contact with you and answer your emails as soon as I can. After my day is done, that's what I'm usually doing, answering emails and helping my students. So I'm there with you, holding your hand. I'm there with you every step of the way. We don't just give you this and say good luck and walk away. As I stated, we're an educational company. This is more like a mentorship as opposed to just selling you and marketing some strategy. Now, you saw the great examples, trading examples from this last month, from this last week, and how well they generated some nice trades. At $6.95 at the normal price, that's really inexpensive, but for all the attendees today, for all the people at Value Charts for offering us this opportunity to speak, we're having an attendee discount down to $4.95. So we're dropping this $200, and we really feel this is a great, great, inexpensive price. If that still is too difficult for you to meet that particular price, believe it or not, we can put together a payment plan for you for $4.95. But this is for a limited time only. So if you're really serious about trading in sync with the market, about learning how to use a very, very simple but consistent technique, I really urge you all to take advantage of this $4.95 price, limited discount price for all the attendees, and come on board as a member of Specialist Trading, and you can be one of my students, okay? Now, as we close here, the way to contact us or any questions or for more information is you can go to our sister site, which is protraderstrategies.com. They market and promote all of my individual strategies, such as I just talked about today. And so that's where you would contact the trading consultants there, and you can email them at trading@protraderstrategies.com or call them directly at area code 310-598-6677, and they will send you all the information as early as today as you like, and you can begin to start learning how to trade strategy number 4 in the next few hours. It's an online course, 5 videos altogether, and you can get that discount by contacting them. But you must contact them, I believe, in the next 2 days, either at 310-598-6677 or email them at trading@protraderstrategies.com. And I want to thank you so much for waiting and for asking any questions, and I will open up the question and answer box and try to go back here. and see what the questions were. I realized some of them were for the previous class. Let me see if I can go back to the beginning here. I don't want to take any of the previous questions. I see some of them are option related, but okay, I see where we are here. Question is, hello sir, in our Indian market conditions, I thoroughly checked so many scripts honestly to say that this is a very good strategy for our market, and I am ready to learn a valuable strategy. Well, that's good to know, Kumar. I'm glad. Yes, well, thank you for the kind words, Kumar. Yes, well, strategy 4, as I said, can be used with other tools that we also have, but strategy 4 on its own is a great strategy, as you saw with just the few examples I was sharing with you. It's a fantastic way to trade. Can you tell us what other strategies are on Metastock charts? We have strategy number 4. We also have for our strategy number 1. We also have strategy number 7. We have a number of different strategies, plus we have a proprietary short-term trend indicator called the PET-D. But I think if you're interested in that and learning more information, since we're not really talking about those today, just to call up the phone number given or speak to the trading consultants at ProTrader Strategies, and they should be able to help you. Okay? Let me see here if I go some more questions here. Carlos is asking, can I use a 55 simple moving average considering it's a Fibonacci number? Yes, Carlos. You know, I always tell this to my students. There's nothing magical about the 50-period simple moving average. It's not like it's been back-tested and researched. It's just that overall, remember what I stated in the beginning of this is that we don't want to overcomplicate our trading. And when you start using different moving averages to meet different markets or time frames, you know, it's getting too complicated. In other words, a lot of traders who intraday trade say, well, I only use a 10 or 20 period simple moving or even exponential moving. And then they say, well, weekly traders, I use a 100 period moving average. And then long-term traders say, no, I always use a 200. Well, if you have to mix and match between each time period, it gets too complicated. And trading shouldn't be that way where you have to change everything for the time period or market. So we found that over time, the 50 period works the best in any time frame and in any market. Now, if you want to go to a 51 or 55 or even a 62, that would be fine. The main thing we're trying to instill in all of our students is that ask yourselves, where is price in relationship to that? Because we're really looking for the overall trend. It's not just something that is so detailed that it has to be, you know, a minute, tick below or above. Just the overall look at the chart. Are the majority of prices below the moving average, whichever one you decide to use, and that should be your what you're looking at. Excuse me, I think somebody may have or somebody's talking. I don't know if you're trying to ask me a question, Dave, or something, but I hear someone else coming in. But that's what should be what you're looking for. So the point I'm saying is that always use whatever time frame you want, but ask yourself, where is price in relationship to that? Okay. Now, I wouldn't use a 200 because it's too far out. A 200 would be obsolete on a 5-minute chart. Excuse me. Just as a 10-period moving average would be obsolete on a monthly chart. You know, they're not in sync. That's why we feel 50 works great for just about any time frame. Okay. Okay, let's see here. Many times price will trade 1 to 5 ticks above a bar and then close down on the day. Sure, that's true, but by trading 1 to 5 ticks above the setup bar, the bar that closes in the top 25%, that actually doesn't happen that much, John. It will happen on just normal bars. You'll see that a lot. You're right. But if you look for those bars that close in the top 25%, that also meet all of the other rules in strategy number 4, you'll see that the odds are in your favor, actually. So you're right. If you're trading by most standards, the way most traders trade, and maybe possibly the way you're trading, it will trade a little above there and then peter out. But if you also use all the other components that we have in this strategy, you're really putting the odds in your favor. Okay? Hilton asks, have you developed these indicators and your PET-D for TDA, Think or Swim yet? First of all, to let the other people know who aren't familiar, the PET-D is a short-term indicator that is great for capturing short-term trend. It's a color bar algorithm. And I know we're working on those. Actually, the people to contact, once again, would be the numbers in front of you. I know we're working on Think or Swim. Okay, I'm not sure about TDA yet, but we're working on that. We have them from Metastock, obviously. We have all of this information from Metastock. So if you're a Metastock user, be sure and contact them because we have the PET-D and all the strategies, all the other indicators as well. Lawrence is asking about the exit technique. I knew someone was going to ask me about that, and I'm sure someone's asking about the stops as well. Remember, Lawrence, people paid good money for all the information, and we can't give you that. It just wouldn't be fair. I'm sure if you paid $700 or $800 for this, you wouldn't be too happy if I was giving it totally away for free on a free webinar. So we have to reserve some of that for the people that paid good money, for our students and members who've already paid the full price. But trust me, you would get all that information plus advanced exits, advanced entries, and advanced stop placement once you become a member of the course, okay? Mike asked a question, does the distance of the current price from the 50-period simple moving average matter if current price is on the right side but far away from the 50-period? That's a good question, Mike. Yes, it does. Only in a personal type of decision. In other words, we have a lot of traders who like to trade as close to the 50-period simple moving average as possible, and I'm one of them because many times you'll see price touch that 50 or get right to it. You'll see a buy or a sell setup, and then you'll see price change, or you'll see the direction change. So I like to take the trades that are closest to the 50-period simple moving average. But this is just a personal choice because there are other trades that are extremely far from the 50-period that work just as well. So it's really a personal choice. It's not something that that's written in stone that you should say, trade these that are far away because there's more momentum involved. It's really something, remember we stated this is an educational course. We want you to empower yourself so that you make the decision. So this is why we tell our students to first paper trade to get an idea of what works best for them. And so they can say, well, you know, I've paper traded this for a while, and I like to trade trades that are as close to the 50 as possible. That works for me. Whereas others may say, no, I want to take those quick trades that are further away. Neither one is right or wrong. The only right or wrong is what works for you. Okay? Let me go to the next question. They're asking if this is being recorded. I believe this is being recorded, so you can get an upload of this. Mike is also asking, must the current candle price, while it's signal on the same side of the 50-period simple moving average where the majority of price candles have developed, say the majority is under the 50, but a signal has generated above the 50. Yes, in fact, we showed you that, Mike. In other words, he's asking the questions of many times price is in the opposite direction of the 50-period simple moving average, but then you get a signal above. The real rule states, and you'll see this once you become a member of the course, is that where an ideal situation, you'd like to see all the prices above or all the prices below. Many times, the truth is, you'll see price oscillating back and forth, as I showed you in a few of those examples. The real rule really is once you get a setup, if it's a buy setup, your entry has to be above the buy-sell line. That's the rule. Okay? Even if the majority of bars are below, as long as your entry, 1 to 5 ticks above the setup bar, is above that 50 period, then it's a valid setup. Okay? You don't see a lot of these, but you will from time to time. Let's say you get a short setup. Okay? Well, if the short setup is mostly above the 50 period simple moving average, and your entry, which is 1 to 5 ticks below that red bar, or the bar that closes in the bottom 25%, is below the 50, well then it's valid. It's still okay. But if it was above the 50, it would not be a valid trade. Okay? Those are just the rules. Okay? Dennis is asking, does this work for MT4? Yes, it does. It does. All of these work on MT4 as well. Strategy number 4 as well. Mike says it looks like the trades you took were at swing points where price has reversed. Well, really, it's more about momentum, Mike. These were just things where they happen to be at swing points. But if you look, if you get a recording of this, I don't want to backtrack. If you look at the hourly chart of the E-mini I showed you, those weren't swing points at all. They were mainly just continuation trades. So this is more of a continuation type of strategy as opposed to a swing trade. I mean, you will see it where it works perfectly on swing trades, but I showed you a lot of examples where it was just kind of going sideways or sideways to upwards, and those were just continuation setups. Okay. Z asks, how do you trade the buy or sell day when the opens is a large gap from the prior close? That's a very good question, Z. Well, remember, first of all, we're not, simply because it's a gap above or below, we are not, in other words, just trying to buy or sell because we're above or below the buy or sell line. We have to have a setup. Now, if you're a stock trader and you are trading daily bars and the setup is perfect to go long, and then you're supposed to buy on the next, I think this is where your question is leading to, you're supposed to buy on the next bar 1 to 5 ticks above, but let's say the bar opens on the next day 2 points higher. Well, obviously, we tell all of our students who trade stocks in this course that if you're a stock trader, you should look for a type of pre-market indication. You can either contact your broker, or you can contact, a lot of charting software packages give you this ability, and you'll get an indication, a pre-opening indication as to where the market's going to open. So this is another way in which to tell where it will be. So in other words, you don't want to buy 2 points above where you would normally buy. Just look at the pre-opening indication, and if you see it's going to be opening at that level, then simply don't take the trade, pass on the trade, and look at another setup. Okay? I hope that answers your question. Diane asks, how do you not get chopped up when price is oscillating back and forth above the 50? That's a good question too, Diane. Remember, I showed you 3 components, but there are roughly about 2 or 3 other components you need in strategy number 4 in order to get and generate a valid signal. So when price is oscillating above and below the 50-period simple moving average, many times all the requirements will not be met, so you won't get a signal altogether. That's why I said to the other gentleman who asked the question, you will see those from time to time, but not a lot, where price is below the 50-period and then you get a buy signal above, because most of the signals will be either enough above or below the 50-period simple moving average, because you will not, the strategy will not generate a valid setup, because all the rules have not been met, because by the very simple fact you're oscillating above. So that's the beauty of this strategy as well. Not that it's guaranteed, but oftentimes it will keep you out of choppy markets, and we all know that it's very difficult to be successful in choppy markets. So this strategy, while not trading perfectly choppy markets, it just simply stays on the sidelines. So that's the beauty of it. Okay. Sandy asks, did you see my question above about what is a 25% bar? I would appreciate it. Okay, Sandy, I'm sorry. Well, it's very simple. I know a lot of students, don't worry, a lot of students get complicated by this. Just take any bar. It doesn't matter. Where students get confused is they think it's a particular candlestick type variation or something. It doesn't matter what bar you're looking at. Just look at the very high of the bar. Let's say the high of the bar is 64, okay? The very high range of that day. We're looking at a daily bar. And let's say the very low of that bar is 60. Okay, so the high and low is 4 points. We measure the range from that day, from the very high to the very low. We're not taking into consideration open or close. We don't care. We're just concerned with what the high was and what the low of the bar. So the high was 64, the low was 60, so the entire range was 4 points. So we want to divide that range into 4 separate but equal quarters. Okay, so the top quarter, the top 25% would be 63 and above. So you want to see that it closed at 63 or above. That's the top quarter or the top 25%, because you divided that range into 4 separate equal parts. The beauty of strategy number 4, what we have for Metastock and the add-on, is that it automatically sets that up for you. So you know it generates a signal for you in real time, whether it closed there or not. Okay. But I hope that answers your question. I have time for just about one more question. I don't want to step on the next presenter. Jeff Gibby's going to speak next. He's probably have a great presentation, so I don't want to take any of his time. Let me just take one more question here. Does Metastock accurately generate a buy and sell signal? Yes, Joe, it does. That's the beauty of this. And with the strategy number 4 course, you automatically get that add-on for Metastock. So it will automatically generate these buy and sell arrows, so you'll be able to know where a signal is generated. And this is great when you're beginning to learn how to trade strategy 4, because it gives you the confirmation that you know you're in sync. That, you know, so many beginners will say, well, I think this is a strategy number 4, but I'm not sure. I better email Steve. If you have the add-on uploaded onto your computer, you will see that the red or green arrow is being generated, so you'll know that you were right. Ultimately, though, through my teaching and corresponding with you, you will be able to spot these things after a month or so without even the help of the arrows. You'll be able to know when there's a signal being generated. Okay. I think that's it. I'm sorry I can't answer any question. If you have more questions, because I don't want to take Jeff's time, if you have more questions about strategy number 4 or anything else we have, any of my strategies or the PET D, please, you can contact any of our trading consultants at trading@protraderstrategies.com. Send them an email. Or you can call us right now at 310-598-6677. Talk to any of the trading consultants, and we'll answer your questions, or if you want that really deep discounted price on strategy number 4 with the add-on, with the automatic add-on, and with my email address, you can get that all for $4.95. If that's still too expensive for you, we can work out some type of payment plan. Okay? So I'm thankful once again. I want to thank you all for taking time out of your Saturday to come and hear me speak, and I want to thank Value Charts for inviting me to present today. And hold on for Jeff Gibby. He's a great presenter, and I'm sure he's going to give you a lot of great information to trade with.
Sound check, guys. How is everybody today? Okay, it looks like I'm broadcasting. It appears I'm broadcasting. Welcome, everybody. We'll go ahead and get started. I'm really glad I could make it today. Ran over to the office about an hour ago, kind of tried to get in, wouldn't let me in, so I'm doing this from the home office. So I'll apologize in advance if we have kids running in here and that kind of stuff. I've barricaded myself into my home office, and hopefully we won't get any distractions like that. If we do, I very much apologize. My name is Jeff Gibby. I've been working for Metastock for about 150 years, it seems. Great job to work for. Actually, I think the closer count is about 17 years. And I very, very much enjoy it. And I'm in charge of our business development department now. And that means I travel all over the place. Going to Australia here in a couple of weeks. Just kind of showing people how to use the software, setting up distribution in international countries, and that kind of stuff. So it's definitely something I very much enjoy. Today, what I'm going to kind of talk about is one of my favorite systems in Metastock. And the reason I like to show this is there's a lot of stuff we can show in Metastock. And believe me, I've spent 2 weeks training people on how to use the software in different countries and stuff like that. But I want to give you something that you can use right out of the box. It's easy to use. It's really 3 simple rules. So let's go ahead and get started, okay? Today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to using and interpreting specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading, and Metastock shall have no liability for any investment decisions based on the use of the software, trading strategies, or any information provided in connection with the company. I lost count on how many times I've read that, but I definitely have it memorized by heart. On another note, too, just so that you're aware, I am not here to give you an investment advice at all. And in fact, I'm not licensed to do that. What I really want to do is I want to show you kind of a simple trading strategy. I love to show this because it works on a lot of stocks. Actually, I've got a whole slide on why I love to show this. So I want to get really specific, though. I'm going to kind of show one thing in the software. You know, Metastock's a huge tool. It's probably got one of the most advanced system testing capabilities that are in there. The scanning, you can do full market scannings in the software. There's even a forecaster that allows you to kind of, that is very cool, that's brand new to Metastock. And you know, we have information about a lot of this stuff on the website, but the only reason I include this as a slide is I want you to understand that we're just talking about a very, very small part of the tool. Not that it's not important, but there's so much more. Our Zenith product, if you're a real-time trader and you're interested in like news and stuff like that, our Zenith product is actually a product that Reuters put together, and they spent like $1 billion on it. And very, very cool. All the time I get people that are canceling much more expensive services to get our news. And very, very, very cool product. So, but I had to kind of get really specific about what I want to cover, just because there's so much we could cover. And certainly we do training all the time. We've got lots of training that's available for free on our website. And so my goal today is kind of give you something you can go home with. I do have, normally I have like a 2-monitor setup, but because of the commotion this morning, I only have a 1-monitor setup. So what I'll do is I'll come in and I'll check on questions every now and again. But you know, I'm just glad I could make it in this morning. So morning for me, afternoon for probably most of you. So we were started in 1982. It's a company that was started by Steve Kalis. Back in 1995, we were purchased by Reuters, and I started in '97. So they were owned by Reuters for a couple of years. We've released some really cool real-time technology. We're very proud of what we've done. We have users that are in 90 different countries. And there's a couple things that I just want to mention before we get into the presentation. And this year, actually, my slide's out of date. It's official now. We won for the 24th year in a row. Best software in our price category. And we won Pro this year as well, which makes it 10 times. So we're pretty happy about that. The other thing that we're really, really happy about is every year we'll query our customers to see how they're doing. The percentage that say that they're more successful in the markets is like right around 85, 86%. People love it. It works really, really well for people. So let's go ahead and kind of just, we're going to kind of only spend a few minutes in PowerPoint. I want to kind of show you really how the system works, kind of go through the rules, how you would kind of adjust trades and things like that. But I always get the question of who Rahul Mohindar is, so I'm going to tell you who he is. Rahul Mohindar is actually a dealer that we have in India. And he's, over the years, been our most successful dealer in the world. He teaches a lot of people how to trade in India, very, very seasoned. And he does a lot of work with CNBC and CNN in India to talk about kind of his methodologies. What we noticed is what happened, and the reason we kind of started to include this particular model in the MetaStock program is we had him in our office in Salt Lake City, I would say probably maybe 6 years ago, maybe 7. And we asked him what he taught his students how to trade and kind of some of the methodologies that he used and that kind of stuff. And he showed us this particular system. And we liked it. We basically include it with MetaStock for free. And it's actually one of my favorite systems in MetaStock. It's the one I would say I would use most often. So I'm glad we bought it for a number of reasons. I have a lot of customers that have over the years say, I really love this RMO system. It's all I use to trade. And personally, it's one of my favorite systems as well, as you'll see as we kind of get going. It is a trend-following system, so I included a definition. I'm not going to read this to you, but you know, the trend is your friend. I'm sure you might have heard that. Maybe like a rising tide lifts all boat, or befriend the trend, and whatever it might be. It's almost a bit of a cliche in the market. Everybody wants to kind of look at kind of what the direction of the trend, buy stocks when they're strong, sell them when they're weak, and kind of trade in the general characteristic of the trend. So this is a trend-following system, and I'm going to show you, it's very, very specific in terms of being able to kind of say, okay, are we in a bullish trend right now, or are we in a bearish trend? My goal today is really just to kind of help you understand exactly how to define that, how digital it is, and understand what you're doing in the marketplace. So again, the reasons I like to show this is, again, it's very easy. At no point, if I do my job properly today, you'll fully understand the system, the rules, how to place your stops, how to get in, how to get out. It's totally, there's 3 rules that are involved, and then there's some money management rules that come into play. But it's a very, very simple system, and that's the reason I like to show it, because MetaStock is a fairly complex tool. It's a huge toolbox, and we give it to traders, and we say, okay, this will help you make money, but we want to keep people using it, and I'd like to give this because it gives you something that you can use right out of the box, if you would. Okay. You'll also notice that during this class, at no point am I going to say, well, I think QE4 is going to do this, or I think that earnings are going to come out on Apple and it's going to gap up real strong, which just happened. What we're going to notice, and when I teach this class live, is every part of this is not subjective at all. It's 100% rule-based. So we're never trying to make educated guesses about earnings or QE4 or a sudden news announcement or that kind of stuff. What we're doing is we're analyzing the trend. If you use the system properly, you're going to use solid money management. You're going to have a stop in place. You're going to understand what your proper risk is. And it does work on a lot of different instruments. I've shown it everywhere. From Saudi Arabia on Saudi Arabian stocks to Egyptian stocks to Australian stocks. It doesn't work on all instruments. It's important to kind of find the instruments that it works well with. But it does work on a lot of different instruments on a lot of different time frames. I have a lot of people. I was reading a Myself, I'm going to kind of focus on daily charts because that's what I use. But I have a lot of people that say, hey, I like to trade this on a 30 or 60-minute chart, and with MetaStock Pro, you can do that. And again, it's a 3 easy-step process. So what we're going to do here is the first step, since we want to follow the trend, it makes sense for us to be able to identify what that primary or that prevailing trend is. So if we know that we're bullish, we want to take trades that are long trades. If we know that we're bearish, we want to take trades that are short trades. So it makes sense for us to want to be able to identify that primary or prevailing trend. And that's really what the first and second steps are about is, okay, are we strong or are we weak right now? Or should we be buying or should we be selling? That kind of stuff. So I'm just going to go ahead and switch over into MetaStock. I've got it preloaded and ready to go. And I did open up a chart of the Dow Jones Industrial Average. We could probably look at a couple of examples a little bit later, depending on how I go at time. Sometimes I go really long. Once I get talking, I talk and talk and talk. So let's just let me show you how to kind of apply the templates and how to start reading it. And we'll start with step number 1. So if you're someone that doesn't have MetaStock, I'm just going to close down this chart real quick and show you how to open it up. It's very, very easy to do. Okay, what I've opened up here, right here, I've clicked on my Power Console, and here I have the different tools that are available to me from within the Power Tool console. We've got charts, Explorer's full market scanning. Here's our system tester, and we have a brand new forecaster, which is very, very cool, cutting edge, patent pending technology. What I'm going to do, what we're going to focus today most on is charts. So I'm going to go ahead and open up the DIA. And maybe Apple, AAPL.O. And I can just put in as many different symbols as I want right here. I just kind of type in the ones, separating them with a space. I can open up as many charts as I want. Go ahead and click on Next here. And what I'm going to do is I'm just going to load in about 2 years, so the default records. With MetaStock Pro, I can select either like minute charts or 30-minute charts or hourly. I'm going to focus on the daily charts. And then what I want to do at this point is I want to apply a template. So that'll apply all the rules, the buy and sell signals, and all that stuff that we'll work with. So I'm going to go ahead and click on this down arrow right here. Okay, and what I'm going to find is I'm going to find the RMO trade model right here. Okay, that's all I have to do. Click on Open a Chart, and it'll open up those 2 charts for me. We'll go ahead and grab the data for them, all that kind of good stuff. Okay, so we've got Apple here. Should have opened up diamonds as well, and I'll just kind of push it so that we're looking at both charts. Okay, now. Yeah, let's do Apple. I normally do Dow because that's what I trade. But I'm going to play a little bit today, so let's go ahead and look at the Apple charts. I'm sure you guys have been kind of following Apple a little bit over the last couple of days. They had a little bit of a surprise announcements and all that kind of stuff, and had a pretty good gap up if you weren't paying attention on late this week. So I'll go ahead and open this up. Okay. Now, step 1, we're going to get back to the rules here. Step 1 is I want to be able to identify the primary or the prevailing trend. Okay. And now what I'm going to use to do that is I'm going to use this top indicator here that's called the Rahul Mohindra oscillator. It's the green one at the very top. I'm actually going to take the other two of these indicators off because I don't use them too much. I'm going to show you how I use these. So what I'm going to do is I'm going to go ahead and drop this into full screen so you can see it. Okay, and we're going to I'm just going to show you how to identify whether you're in a bullish trend or a bearish trend from a long-term perspective. Okay, and when I say primary trend, remember step 1 was identify the primary trend. All that means is the long-term trend. What is this thing doing long-term? Okay, so when I say primary, that's basically looking at the most amount of data, determining if a trend exists in the stock, and determining if we're bearish or bullish. Okay. Now what I'm going to do here, we'll go ahead and zoom in a little bit. I can do that in MetaStock just by clicking this little plus sign. I'm going to make a couple of very easy observations about this particular indicator, if you would. Number 1, it's green, pretty obvious. Number 2, it's either going to be above 0 or below 0. And sometimes it's way above 0 and below 0, but that really doesn't matter for the way that we want to interpret it. This is a digital indicator. So the way we read this indicator, it's measuring our long-term trend. And it's very, very simple. primary trend. I'm going to say if it's bullish, basically it's above 0. So if it's above 0, then we're currently bullish on Apple, okay, long term. So if it's bullish because it's above 0, that means two things. Number one, we're not going to, well, a few things. Number one, we're not going to take a trade just because it's bullish. There's 3 steps that are involved to kind of figuring out where you want to trade on the chart. What we're going to say is, so we're only going to take a long positions here. Okay, so as long as it's bullish, we're only going to take long positions. Okay, and we're not allowed to go short. Have my laptop keyboard, so I'm a little slow at typing on this one. But again, I'm just glad I made it today. If we're down below 0, we're going to say it's bearish, which means we would just reverse those rules. We'd be allowed to go short. We wouldn't take long positions. It's that easy. So right now, for the last 4 or 5 days in Apple, it's been in a bullish zone. We wouldn't be looking to take short positions. We'd be taking long positions. Okay, and Apple's been in a little bit of a sideways pattern lately, but right now we're going to follow the rules. We're bullish at how we had that huge gap up a couple of days ago. We're only going to be looking at taking long positions, and that would have happened on the 22nd. We'd be looking to take long positions. Okay, so that's really rule number 1 in a nutshell. Oh, actually, that's not exactly what I meant to do, but that's okay. I'm dealing with a little bit of a littler keyboard. What I'm going to do here is I'll go back into, well, that's my phone software. Again, you guys, I normally close that down. Let me go ahead and go back into the PowerPoint. Again, we want to identify that primary trend. So if it's in a bullish zone, we're allowed to buy, we're not allowed to short, and it's not a trigger to enter. Okay. So that's step 1 in a nutshell. It's really a pretty easy system to use. What we want to do now is we want to identify what the short-term trend is doing. And because I have only one monitor on my home computer and I can't see the questions, what I'm going to do is I'm going to go ahead and take a short break to see what questions have come in, and then we'll go into step number 2. Step number 1, we definitely want to answer any questions that are there about that particular thing. So let me pull up the webinar console here. I'll just see if there's any questions that have come in. And we'll just take a second to answer a couple questions. I'll do this a couple times. Okay, a couple of questions. RMO means Rahul Mohinder Oscillator. Am I correct? Yes. Does Metastock backtest strategies? Yes, Diane. Diane Simmons asks us Metastock backtest strategies. And I like the Metastock backtester. I will be the first to admit I'm very biased. But it does allow you to backtest as many strategies as you want against as many systems as you want through portfolio backtesting. And I always talk to people that may not be computer programmers that really like our system because it's very, very simple to work with and use. Diane says, I find the market trends less and then it chops. In equity, my gains are lost in chop. How can this cycle be changed? I mean, that's a really good question and probably the subject of a different class, to be honest with you. But with RMO, I just kind of deal with the chop on diamonds. There's been periods of time where I'll take 6 or 7 very minimal losses in a row. And then what you'll do is you'll find that what I found is I still make money. So I'm willing to take those chops because when the trend establishes, particularly on diamonds, it establishes in a very, very strong way. To establish trend, you look at weekly and monthly in Metastock. Not with this system, Mr. Smith. With this one, basically, you're just basically looking at the same interval. This long-term oscillator is actually going to be looking at a long-term system. ISPEL says, or ISPIS says, this is the MACD. What are the differences? I can assure you this isn't MACD. I'm very familiar with the MACD system, which is a great system. I like this one a little bit better. It's a proprietary formula, and it's not based on MACD. Cool. Okay. That's the questions for now. Let's go to step number 2. let me go ahead and minimize this real quick, or get the questions out of my way. And we can kind of go into what step number 2 is. So just to recap what we were doing, we were looking at the primary trend. We're establishing that right now on Apple we would be bullish. Okay. And the other thing that I want to do before I talk about step number 1 is I want to point out the ribbon here on the bottom of the chart. You'll see right here that it's bearish. Bullish, bearish, bullish, bearish, bullish. So you can identify either by looking at the indicator that's above 0, which is very easy to do, or it's also very easy to actually look at the ribbon that's painted on the bottom of this chart to tell you whether it's in a bullish or bearish zone. Okay? Cool. Awesome. Let's go ahead and go to step number 2 here. I'm going to go ahead and maximize these. Let me just hide my view or my control panel. I'm so used to dealing with more than one computer or more than one monitor, but my control panel's right in the way of the button that I want. Let me move that out of the way. And I'm going to move this to full screen. Now there are 2 indicators right now. I'm going to change the view just a little bit so I can kind of get a little bit more specific about which indicator we're talking about. We'll deal with the pink indicator right now. And I'm not sure exactly what the technical color for this is, but I call it pink. And you'll notice that it's a lot more reactive, I'll say it's probably the right word to use, to market conditions. So, and as a result, we're looking at a shorter term time frame. But we read it in the exact same way. The only difference is this is measuring a shorter distance or a shorter time frame. So this is your swing trade number 2 indicator. And we're going to use that to identify what this is doing from a short-term perspective. And we read it the same way. If it's above 0, it's bullish. If it's below 0, it's bearish. So very easily, I can kind of look and say for the last 4 days on Apple, this has been in a bullish zone. Okay, so if it's in a bullish and my long term is bullish, so it has to match the long term. But if they're both bullish, I'm still allowed to buy. Okay, it's that simple. So both of them have to match up. If they're both bullish and we have a long bias and we're only taking long positions, if they're both bearish, then you're basically looking at short positions only. And that's how you would actually read it. As long as they match, you're allowed to buy. Now, if they don't match, and a lot of times they won't, in this particular case, because we've had a very good strong, they both match. But if they don't match up, then you're allowed to wait. Okay? And I think that's very important. We want to kind of move in the direction of the general trend, short term and long term. And what that does, in my opinion, is it helps you keep the odds in your favor when you're trading. So right here we've got a good solid trend we're allowed to buy, and that's simply step number 2. Okay. The other thing that I'll point out with this particular set of indicators right here is you'll notice that when this goes down below 0, because I'm going to point it out to you, that the bars actually begin to color red. When it goes up above 0 for that short-term indicator, we start to color the bars blue for you. Okay? Does that make sense? Hope so, because I can't see if you're asking questions right now. In this particular case, we'd be up above, we'd be looking at bullish and bullish. So we can't trade Apple 2 days ago or 3 days ago before this gap, but we'd be looking to take a long opportunity in it at this point if we just started looking at Apple today. Hope that's clear for everybody. Let's go back to the PowerPoint, and I'll just revisit the rules. I think I try and kind of repeat the rules a few times just so that they make sense. So your primary trend, if they're both bullish, you're allowed to buy. You're still not allowed to short, and it's not a trigger. Okay, so in other words, we're just kind of doing our homework right now. We're not buying or selling anything until we get step number 3 in place. And that's where we start to talk about how to manage your money, how to manage your assets, and how to kind of look at that. Okay. If they don't match, you do have a couple opportunities. You can wait, or if you really want to start to take a trade, the meta-stock scanning actually will allow you to find any opportunity that's currently matching for that long-term and short-term trend. So you can use the scanner, and if we have time, I'll show you how to do that. It's very, very easy to use. Okay. Now what we want to do is we kind of want to get in and we want to identify the trigger points. So, and for this particular one, we've identified that Apple is bullish long-term and bullish short-term. What we want to do is now we want to kind of do our trigger. And this will include a lot of important things. So I'd ask you to pay a little bit of attention here, because what we're going to be talking about is how to move your stops and how to kind of trade in conjunction with the trend, and when you get confirming signals to kind of move along with those. So let's go ahead and go back to my Apple chart here. Okay, and we'll just pretend that it's 2 days before this major kind of gap up. So I'm going to pretend that it's 422. Okay, and this isn't going to work out as good as you think it's going to, and I'll show you why in just a second as we get into the rules. We actually probably wouldn't have taken that position just yet. We would have done it at the open, but I'm kind of skipping ahead of myself. Let me jump to the other 2 indicators right here. And I'm going to change this right here to another line. So we're going to have 2 lines here, okay? And the reason I want to change that to a line is I want to talk about what we're looking for in a buy signal. So right now in Apple, we know that we're bullish long-term. We know that we're bullish short-term. What we're looking for is a change of momentum or a change of force to get us into a particular trade. So in this particular case, the pink line, again, like I said a little bit earlier, is the short-term trend. The green line's your long-term trend. And this blue line, you've probably guessed already, is your medium-term trend. And this is where it gets a little bit different, because I don't care if that's above 0 or below 0. What I'm looking for is I'm really looking at the relationship of price and momentum in the market. If I was to kind of study this particular area right here and look at it with the price movement of the chart, what we're going to see is we're going to see a shift of momentum. In other words, this line, both of these lines are starting to head up because the momentum is starting to shift and people are starting to accumulate Apple. And so what we call this when it crosses right here, I'm just going to move it back 1 day here, move this vertical line back 1 day. When this cross happens, what we call that is, Rahul calls it a change of momentum and a change of direction or a change of force. And that when that happens, that's actually our signal to go ahead and get into the market. And in that way, to kind of address one of the questions from earlier, it is similar to like a moving average crossover system. What you're looking at is a very specific way to look at the momentum for the stock. Okay, so the cross that happened between the 21st and the 22nd happened right there. Okay, so if we were looking at this on the 22nd, what we would be saying here is, okay, here we've got a signal to go long. Okay, we went from bearish to bullish yesterday, and we went for long term, and we went from bearish to bullish short term yesterday. That is what we would call a typical trade setup or a trade pattern. Okay, so now what I'd like to do is show you how you would take advantage of that. And with this particular example, you're going to miss the gap. That's just going to be the way that it's going to go. This was a very surprising gap, but you're going to miss it because of the way the rules come into play. I'm just going to show you the way they work. I'm not going to kind of cherry pick things here. What I'm going to do is, when we get this buy signal and everything's confirmed, we're going to look at the recent price activity. Okay, I'm going to look at the high here for this bar and the high for the previous bar. I'm going to say just by a little bit that this particular bar is a little bit higher. So the way we trade this is we take a look at the highs and we put an entry spot right above the highs. What we want to do is we want to be able to confirm that we want an additional confirmation. Let me change the way I'm saying this. We want an additional confirmation that this is going to start to trade in the direction of the trend for us. So what I'm going to say is, if it goes above the highs and we start to get higher highs, if it crosses above this high, it's a confirmed. We're going to go ahead and enter. And what we're going to do is we're going to enter as close to $533.60 as we can. Okay, 533.60. Okay, that's kind of until the price goes up above that, we're not going to buy. Okay, now what we also want to be able to look at is we want to be able to look at kind of where we want to kind of measure our risk and put our risk. And I talk to traders all the time that are like, I I put my stops here because this is how much I can afford to lose, which is not a very good way to trade because I don't think it matters how much you can afford to lose. But I do think risk is important. And there's two different ways that Rahul teaches to manage a stop or to manage an initial stop when you're entering a trade. What I'm going to do, before we looked at the highs, now I'm going to look at the lows. The low here is 526, and the low here is right about 531. So this one's lower. Is that right? It doesn't look lower, but again, I'm working on a smaller screen than normal. That's lower. So then I'm actually going to put my exit or my stop loss right below those lows. That's the first way that Rahul teaches. I like this method. The other way, and I'd recommend that you find one that you like, is you play with them and see which one works better for you. The other way Rahul teaches to look at the stops, as he says, look at a low support area and put in a stop loss right at that area. So if I was using that particular methodology, what I'd probably do is put a stop right here at about 509. Either way, I'm either going to have a stop loss here at 522, or I'm going to have a stop loss here at 509. Okay, so now I've got a good, and I always ask this when I'm doing a class, what do I know here? Okay, well, I know that unless there's a huge gap up in price, which actually just happened in this instance, so the market is never too predictable, right? But unless there's a huge gap up in price like there was, I'm going to get in pretty close to 533. Okay, and unless Apple gaps huge down in price, which again we might have a huge gap down, if I get in at that level, I'm either going to get out at 522 or at 509, depending on which method you like to use, the first one, the one I prefer, or the second one. So what we've got, since I can ask the questions to you and see the responses easily, what we've got here is very important. We've got a measurement of what, in normal circumstances, is going to be our risk for the market. Okay. Now, in this particular case, I know, in most cases, what I'd know is I'm going to get in at about 533, and I'm going to get out at 522. And for 500, to risk 11 points isn't really that much, but I'm basing that on kind of what the price is doing. Or I'm going to get in at 533 if you like the other stop loss method, and I recommend you play with both of them because I'm just showing you what I like. And I get out at 509, I'm risking about 30 points, which isn't that much on a $500 stock. What is that? 30 points divided by 5. I think that's about a 6% loss. So I know I'm risking either 11 points, which is very little on this particular switch, or 6% on the other stock method. Okay. Now, in this particular case, we did have a huge gap up. And to be frank, this is where you would have bought Apple. You would have bought it at the open here at 568. And you could have made another assessment. Wow, that's a 30-point gap up. Does my risk reward look good? Should I still buy this? But you still know what your risk is, and you can make that decision on the open of the bar. Okay. Now, is Apple going to continue to go up? I guess we'll find out. If you're following the rules very specifically, you would have gotten in on the open of this day. Okay, and I would say that's a pretty strong gap up. Everything looks bullish. I wouldn't necessarily recommend that you buy or sell Apple because I can't. I'm not even going to say what I would probably do because I don't want to get into the whole business of recommending. It's just not my job role, and I certainly, Okay, so let's go back a little bit as well, because I like to show Apple for a very specific reason. I've done this demo for years now, years and years and years, and a lot of people, as they were kind of talking and we'd kind of go into demos, I'd say, hey, what stocks do you guys want to look at today? And they'd be like, Apple. Apple would come up almost every time. And I'd kind of go through and start to show how the rules work, and you guys remember Apple, how it was behaving before this year. I'm going to kind of scroll back out here and look at a macro view of this. And we kind of start to go in and look at the signals. I say, okay, you buy here, and you put your stop here, and you move your stop, and you move your stop, and you move your stop. And what people would always say is like, well, I could buy Apple, and I could hold on to it forever. But obviously that isn't always the case. So being able to identify the trend with these very, very huge stocks that go up forever and trade in direction of the trend is very, very beneficial. It says I might be experiencing network connection difficulties. I don't have any internet stuff running, so hopefully everything's coming through pretty good and that there's not a problem. It just popped open to tell me I might be having some network difficulties. What I want to, so I would argue that, though, if you notice on this big, huge uptrend, let me go ahead and get this GoToMeeting out of my way for a minute, we were bullish for most of that time. And I would say, and then for the big downtrend that we had after kind of the collapse, I'm just going to kind of go out a little bit more. This big collapse we had, we were bearish for that whole run. And remember, this was up to where it collapsed. You know, it would not, it is a trend following system. I want to give you really realistic expectations of what to happen. Apple topped out at about $6.99. Okay, we didn't get short on Apple because of how strong the trend was until $6.39. Okay, but we would have gotten out. I'm going to show you how you would have exited a specific trade. We'd have gotten out probably right about here based on that, and we wouldn't have been long. We would have taken a short position right probably about right here in this area somewhere. And I'd argue that being bearish during this whole run down and only taking short positions is going to be beneficial for you. Okay. Also, saying it the other way, being bearish, if we just use the bullish bearish indicators here to kind of trade in conjunction with what the trend's doing, being bullish during this huge run up and this huge run up and only taking long positions, well, that's what we talk about when we start to talk about putting the odds in your favor. This isn't a sexy system. It's a really good system, but it uses a lot of common sense. So let's go ahead and just kind of, I want to play through one of these kind of scenarios with you so that you understand how to move your stops, how to get out of the stock when the trend comes out, and how to kind of match in those profits and stuff like that. So I'm going to start right about just here at the beginning of this big uptrend. And we'll kind of use our way back machine, and that's always, I will agree, I'm sure somebody that's a little in the audience is going to say it's always easier to trade on this side of the chart than it is to trade on this side of the chart. 100% agree with you. But since I don't have data that's in the future, I have to show you examples that are in history. So I'm going to show you a historical example. We'll use that as a way to kind of teach you how you would actually kind of go through a trade. And then what I'm going to do at the end is show you how you can try this for yourself without on a very, very nice 3-month trial. And if you like it, you can trade it. There's 35 systems in MetaStock that you can use as well. So let's just kind of look at, and I'm going to get even a bit closer here. I just want to be able to kind of just narrow this in. Let's look at kind of right here. Let's say we started looking at Apple at about 2011. So this is way back. Here we would have gotten a buy signal or a signal to get into the market, but again, we can't trade because we're bearish both long-term and we're bearish short-term. So if anything, we'd be looking to go short. We're certainly not going to take this signal that's in the direction that's opposite of the trend, so to speak. The next day, what happens is we get a blue bar, and what that means is we just barely went above zero with our short-term trend, but we're still in a bearish zone. We're still not allowed to buy. It's not until a couple of days later that everything kind of looks good. The traffic lights have kind of lined up for us. And what we want to do now is we want to start to structure in a long position. And the way we would do that is exactly kind of like what we were talking about before. Look at the high. Look at the high on the bar before. And I'm just going to kind of identify that's my high point, right? I'm going to say, okay, if it goes above this point, that's my confirmation. This thing's going to rocket up to $700. I didn't know, you wouldn't know that at the time, but this is my confirmation that when it goes above this level, that we're breaking new highs, and that the trend is confirmed. We're going to go ahead and buy as soon as it goes. And we do the same thing with our stops. Okay, if we're wrong, the low here is 396, and the low here is 392. So I'm going to put it right below 392. Right above that thing. Or if you use Rahul's other technique, you put it right here. So again, I know at this point, I'm going to get in at about $399. If it goes against me, I'm risking $7 a share. I'm going to get out just below $392. In this case, $391. So $8 per share. My mistake. Okay. So the very next day, it opens right below that line. We get in just as close, but as it starts to go up for the day, we would go ahead and buy on this day. And that's how we would do it. That's how we would structure that trade. Okay, we would buy on this day. I just go ahead and put that signal on the chart. So you'd kind of know exactly what they were talking about. We put on our stop. Again, the stops, if there's anything I've learned, stops shouldn't be negotiable after they're placed. In other words, if this comes down to 392, you get out. You can decide on what strategy you want to use for stops, but not in the heat of battle, so to speak. You want to be definitely, the nice thing about trading this way and with technical analysis is you're not making decisions on the fly. You're deciding what you want to do well in advance. You've got your game plan, and you're going to stick to your game plan. Okay. When you're not trading, well, I bought this and it's coming and coming against me, but I think I'm going to stop out and it's going to go back up. Those are not the decisions to be making. The market and this system will give you more opportunities to buy if you're wrong, but generally you want to get out and you want to preserve that capital, and you don't want to be making decisions while you've got real money. I mean, that's the advantage is, and you hear it all the time, the emotions. You should be buying when people are selling and selling when people are buying. Emotions are not your friend when you're trading. I'm sure most of you know that. And so you want to make the decisions on where your stop loss is before heat of battle. And when you're in the middle of a trade, you're not negotiating these. Okay? So here we get in. Boom. Okay? And as long as we're in, we get a nice, well, we kind of get a bit of sideways action. Just going to start to zoom out a little bit. Okay? And we get a nice big uptrend. And as long as nothing really changes on the chart, we're just going to kind of go ahead and let it fish. We're not going to move our stop yet. We're not going to we're not going to get out. We're not going to kind of take a decision just because this is a good trade and we've already made enough money. We're going to stay in there until we kind of get a signal that things might be changing. In this particular case, this was a huge run up. I mean, we've already gone up quite a bit. What happens is, as all markets do, kind of get a little bit of a topping formation. Your signal starts to cross down, and you get a sell signal on the chart. Okay, so we're in a long position. We get a sell signal. I want to be really, really specific about what you want to do here, because this is kind of an important part of the rule set. When you get a sell signal, you're going to take a look at your trend, and as long as you stay bullish short term and long term, you're going to stay in the trade. Okay, this might start to pull back. If everything starts to go negative and then the trend's changed, then we would reverse our trade. But as long as we kind of have a minor bit of a pullback, what we're going to do is we're going to stay in this, because what's usually going to happen in a really strong trend is you're going to establish a new support area, and what's going to happen is it's going to start going up again. So here we've established this support area. The stock stays there, and then it starts to move up again. And that's just normal market behavior. Okay, so we don't necessarily want to pull the plug as soon as it goes against us a little bit. What we want to do is we want to analyze that. So in this particular case, everything stayed bullish, everything was good. What we want to do now is we have that cross that happens, and generally the way I read that is you've established a new support area. You anticipate that the market's going to continue to rise in the direction. You're getting another signal that that's the case on the chart, and what you want to do here is very, very specific. And when I'm doing this class live, I say, what do you think we want to do here? And people say normally buy more shares, which isn't what Rockwell teaches. He's very specific. He wants you to buy as many shares as you're going to do at the start of the trade. But the thing that you definitely want to do is, since you anticipate we've got a new support zone in here, we've made some money, we want to move our stop loss to accommodate that. So what I'm going to do is I'm going to look at the lows here, and I'm going to say, okay, now if it goes down to right here, in this case 541, I'm going to get out. That's my new stop area. Okay, so now instead of protecting my my capital, I'm protecting my profits. Okay, and it works very, very well. So here we go. We go ahead and put this in as a new stop loss or a new stop area. Okay, and it continues to go up, so we kind of just let it fish here. What we're starting to get is we're starting to get a little bit top heavy because it establishes a new high, and again, this is very typical market behavior. We get a signal that that might be changing, and then we get a new thing. And when this market starts to tighten a little bit, our stops start to get a little bit tighter as well. And that's just because the market is it's heavy, it's top heavy at this point. It's likely to change direction. And the RMO allows us to kind of take advantage of that by kind of moving our stops as kind of the trend accelerates. So now we're saying, okay, if it goes below 593, we're going to go ahead and get out. Okay, it doesn't. We basically it pulls back a little bit here, and then we kind of here we set up a new stop. At this point, we're just kind of watching the market behavior. We're not stressed out. We kind of know exactly what our profits and losses look like, and here we stop out of that particular trade at 616. Okay, so we got in. It's a great trade. We got in here. We took advantage of most of this big trend up. It went up quite a bit more after this. We would have had more opportunities to buy back in here when it continues to go up. But what we've got is a very good mechanism for kind of taking advantage of these big trend movements. Okay, and I remember actually talking to people all the way through this time of year saying, hey, well, it doesn't matter. Apple's always going to go up. It's going to continue to go straight up. You don't need to necessarily worry about having a trading strategy for this. The trend is too good. But we all know that that's not true. And certainly hindsight has proved that that's not true. It's always better, I think, to have a strategy in place. Okay, and this is a very good one to have. I'm going to show you a couple examples from diamonds. We've had a hugely volatile market the last couple of years. How am I doing on time? Not great. Okay. Let's go and do a little bit of QA, and then I'll kind of just show you a couple of examples, and we'll let you get on with your Saturday. Okay, questions. Let me pop this out. Again, normally I try and answer questions as they come in, but normally I have a really nice office environment with 2 monitors, and I'm not crashed in my basement trying to not disturb the kids too much. So, John asked a question that I think is important. Why do your indicators say sell when price was going up? I didn't see that as an example. I actually read that, when I read that out loud, I totally read it differently when I read it in my head. I thought you were saying, why do the indicators say the price is going up, which it's definitely not. And it's definitely not right. Like I said, I've taken probably the most I've taken in that are kind of choppy trades where you just stopped out, 7 or 8 in a row. CK asked a question, does it work for a shorter time frame, like a 5-minute chart? You know what? I have talked to a lot of people that trade on like a 30 and a 60-minute chart, and they tell me it works really, really well on that. What I would say to you is try it out. There might be better systems that you can use that work on the shorter time frame charts. I don't have a lot of experience with playing with 5-minute charts. Certainly have access to all of the data and all of the charts, but a lot of people ask me, why do you like to trade these systems that are so long term? I mean, you can stay in a trade for 6 months, 9 months, as long as the trend's in your favor. And I always tell them, you know, I work probably like 50, 60 hours every week. I've got 3 kids upstairs, and for me, a system where I'm just kind of trading in the direction of the trend and not stressed out about it all the time works really, really well for me. So the nice thing about being able to do like the extended trial that I'm going to tell you about is the fact that you can actually play with this. See if you like it. There might be something else that you like in Metastock. Remember, it's a very small part of Metastock. Edgar says, can you tell me if this webinar is being recorded? I can absolutely assure you it's being recorded. If you gap down, this is a great question, Diane. What happens if it gap down? So we had that huge gap up. And at that point, we can make a decision if we want to still buy because we know what our risk-reward ratio is going to look like at the very end of the chart, right? If it gaps down, do you honor your stop, is what Diane said. Absolutely. I haven't come into a situation, again, no, that I trade the DIAs, but your stops are not negotiable. So if it gaps down really hard against you, you might be looking at kind of a different market scenario, and absolutely, as soon as it goes below that level, your stop is not negotiable, in my opinion. Okay, let me show you a couple of examples of diamonds. I mean, I think as traders, if you have something that works well right now, in my lifetime, I've never seen such a volatile marketplace as we've had in the last several years. It seems like things are starting to calm down a little bit, but certainly, like if you remember kind of the housing crisis or the big bull market that we had after that, or those kind of things, it's been a great time to follow the markets and a great few years to trade. I don't necessarily see volatility or trends going away from our marketplace, but I just want to show you a few things, and we're kind of running low on time. So I'm going to switch back over to this diamond chart here and just kind of show you how it works on a major ETF. Okay. Now, we're not going to kind of get into the nitty-gritty of it, but let me just point out we've had a pretty good bull run so far this year. And again, we're bullish this year. Okay. I'm just going to load in a ton of data so I can show you kind of the things that I think are kind of pretty cool here. 2000. Oh, go ahead and, oh, yeah, changing the wrong date. Let's go ahead and just click on load next one data. 2014. Okay. And what I'm going to do here is I'm going to go back to, with a lot of the instruments, you can go back into the 80s with Reuters data. We're lucky to have so much data. 182 exchanges with Reuters and that kind of, just very good data. So bullish all year this year, with the exception of just a few kind of blips on the screen. I wonder if a lot of you guys, I'm sure you guys have been trading for a while. I wonder if you guys remember that big housing crisis and the big market that we had back then. Where am I at on the chart? 2005. Okay. And again, these huge bull runs are where you're going to make money in the market. Bulls make money, bears make money, pigs get slaughtered is one of my favorite sayings that Robert Dill used to kind of talk about all the time. What I'm going to is kind of the collapse of the market. Which happened I think it was right here. This is that big, huge collapse that we had. And I just want to show you, it took a lot of people by surprise, but, the markets weren't just weak at that particular time. They were terribly weak. For 2 years, we had kind of in a downtrend. It would have been bearish since June of the year before that really big surprise with the housing crisis. And so if you were not taking long positions, if you're kind of all in cash, like I was, or short, which I should have been, you would have been able to kind of take advantage of kind of that downward movement. Okay, and yeah, I don't know. I mean, I think we kind of forget pain, but you remember how the whole economy was about to collapse and things were going terribly, and there's never going to be a market recovery, and all of that kind of stuff. I mean, there was a lot of panic and fear. But eventually, what happens is in March, we established a really good, deep support level, okay? And look, we didn't start to go long in March. It wasn't until April that we actually started to go long because the trend was so severe. But I remember being at the money show, and we were pulling stock after stock after stock after stock, and it was probably around August or September of that year. And he's like, well, every stock you've showed me told me to buy back in April. And I just laughed at him. I'm like, well, you could have probably just bought about anything back in April. But nobody knew back in April that was going to be kind of, that we'd set a new low. It was probably one of the biggest bull corrections I've seen ever. But I've only been following it for 20 or 30 years. There's a lot of you that have been doing it for a lot longer. But for the most part, this is helping you stay in the direction of those overall trends. And this huge bull market that we had, it was bullish the whole time. The correction that we had after that, it was bearish. I have actually a slideshow that shows every single example, but I think you get the point. Trading in the direction of the trend is a very, very valid way to trade. The reason I like it is it's also a good way for you to kind of minimize those losses. And I believe you. I believe some people can actually kind of look at systems, and there are certainly ones that are counter-trend. I believe trading in the direction of the trend is, in my opinion, and I say that very specifically, my opinion, very easy way to make money. Probably the easiest way to make money in the market. Let's do a little bit of questions here. Let me pop this out. I wonder if you guys can see the questions. There's only one more. Does the RMO price bars change colors when the swing tree crosses? No. When it changes from blue to red, if you're short-term positive or short-term negative. So it's looking at the short-term trend. That's when it's changing colors. The arrows are indicated when you go from bullish to bearish. Okay. Diane says you can't see. Trend following, I think, is the best way to trade the market. Now, that's just my opinion. And opinions are like armpits. I'm sure you heard that saying before. Some of them are good, some of them are bad. Diana asks, what's the price of Metastock? Well, that's a perfect segue to what we're going to be talking about. Now, there are, because of the thing, I'm not sure I had a chance to kind of get rid of all of the examples that I used during the chart. I did. Luckily enough, I had this all ready to go. Otherwise, we would have been in serious trouble. But so there again, the reason I like this is it's easy. Again, we're not making assumptions based on what housing is doing, or QE2 or QE3. We're looking at the trend. It's 100% objective. We're not making any guesses. We're not always right, and you're never always going to be right, but you're making good judgment calls based on what the stock's actually doing and what investors are doing with the stock. I think that's important. If you follow the rules, you're going to have your stops. You're going to have solid money management. Works on all time frames in Metastock and many different instruments. Notice I say many different, not all. Play with it. I'm going to give you 3 months to evaluate Metastock for a very low cost. And if you like it, you'll probably trade it as much as I do. I mean, I talk to people all the time that love RMO and Metastock and that kind of stuff. Again, we're pretty proud of ourselves, but I think we should be. 24 years in a row. I need to update this slide. Phenomenal. But I'm more proud of the fact that most of our customers actually make money in the market. I was in Vegas for the user conference right around Thanksgiving. It was like a couple weeks before Thanksgiving, like it always is. And I talked one of our customers into trying Metastock on the same offer I'm going to give you today. And he bought it back in, it would have been November. I met him again on one of our road shows. I do a lot of traveling, as you might imagine. And he basically, he said, okay, I'll do the 3-for-1 trial. If this software pays for itself, I'm going to buy a one-time license, and I'll just own it forever. And he was looking at Pro. And I saw him a few weeks later, and he's like, I saw him a few months later, so he had a chance to kind of play with everything, get everything kind of situated and running. And he said to me, in Southern California, I'm trying to remember what city I was in, but I can't remember. Actually, you travel too much when you don't remember what city you actually were in. But it was Southern California, and he said, I met him February, and he said, you know what, I've made enough money from Metastock to pay for the real-time version and the data 5 times already. And that was within about, I'd say, 3 or 4 months. Over the holidays and stuff like that. So I really think Metastock is something that's very, very valuable for you. The Metastock, this offer I'm going to give you today, we have an end-of-day version. And I call it end-of-day, but with the latest version, it actually gives you hourly update bars. So you actually can see what's going on in the day, which is something that we just added in October. But it's only $59 a month. And that includes the data for either all of North and South America, which is what most of you, I think, will get. Or you can get Europe, Middle East, and Africa. Or you can get Asia Pacific. So it's $59 a month. That includes everything you need. You just download the software. It's all ready to go for you. If you buy one, what I'm going to do is I'm going to give you 3. Metastock's a huge tool. I want you to have plenty of time to use it. So basically, March, April, we're in April now, May, June, July. You'd be running until kind of the end of July if you set up today, and you pay $20 a month for that. And that'll give you more than enough to be able to kind of play with all of the tools, the new forecasting, the system testing, the scanning, whatever it is that you want. And what you're going to find is that you're making money and you keep the subscription. Or if you don't like it and you don't agree that it's going to help you make money, you can always cancel it. We don't have anything that's like any contracts that you have to sign up for. This is our offer to let you try it and see that it's going to work for you. Our Metastock Pro program includes the Zenith data, and it's a product of Thomson Reuters. It includes like their real-time flagship product that's called Metastock, or it's called Icon, and we actually call it Zenith. We charge a lot less for it, but you pay about $250 for that. Now, there are cheaper options. You can buy them as a one-time cost, which brings that cost down to $100 or $150 a month. I just encourage you to try it. Give it a shot. If it helps you make money, like anything else, it's more than worth the cost. And with trading software, if it doesn't help you make money, it's not worth even paying for. So give it a shot. This is kind of a low-risk offer. Get you into the software, allow you to go through all the training that we offer and all that kind of good stuff that we've put together to make sure you're successful and that you keep the program. And go ahead and get that signed up, and we can kind of get you rolling with it. Okay. In addition, we include like this Unleash the Power of Metastock that kind of talks about RMO, talks about a whole lot of other things, and even a free month of online training. It's about 60 hours of classroom training, or I'm sorry, the class. It's an hour a week, Tuesday, Wednesday, Thursday. So it's actually 12 hours, but there's more than 60 hours of recorded training that you can go through at your leisure as well. That's done by a company called LearnMetastock.com. So what, in my opinion, Metastock's a program that's going to help you make money. I'm going to give you a very low-risk offer to help you kind of get started and kind of learn what you're doing and totally give the program a test drive. All I ask is that you try it for 3 months. If you like it, keep it. If it helps you make money, that's exactly what you want to do. So to take advantage of that, you can call our sales guys. They're not in today, but you can also go to Value Charts 3-for-1, metastock.com/Value Charts 3-for-1. If you call and mention Value Charts for the extended trial. And here's my email if you want to email me. You're definitely get an answer. I promise. Jeffrey.gibby@metastock.com. Couple questions that came in. Ed says, do you agree that trend trading needs to be done on a daily, weekly, or higher time frame? Not necessarily. I only do dailies. I have customers that do hourlies in 30 minutes. I personally, there was a question earlier of, does this work on a 5-minute chart? I think you get a lot more noise at 5 minutes, so that's why I'd encourage you to try it. But for me, I've done trend trading on a daily chart for years. I don't think you need to go any higher than that. I have customers that have told me that they're successful trading them on an hourly chart. It's just, you know, if I stopped working and start trading, they probably wouldn't, my performance at work would suffer, I'm sure. We do have videos, Diane, on how to do all the scanning, the back testing, how to use the forecaster, how to use all of the tools. I mean, we want to make sure you're using it, and those are all available for free, and they're up on our website. Diane says, do we pay for strategies as well? There's about 40 or so systems that are built into the system that you can test and you can look with and you can play with. And I'm sure you'll be able to find something that works well. ETF, Diane, is, wow, that's a good question. I said wow because I hope I can give you a good answer. An ETF is like buying a stock in some ways because you can buy it like a stock. You buy shares of like DIA. Is like buying a stock. You can buy them as you would a stock. But really what you're doing when you buy an ETF is you're usually buying, in the case of diamonds, you're actually buying the Dow Jones Industrial Average, sort of. I mean, it's basically a mutual fund where they keep their, they keep it so that as the Dow Industrial goes up, the diamond will go up, the DIA will go up. So it's a way for you to kind of make a broad-based assessment of the market. And the reason I like to do that is because I think it's a little bit less risky. It's not like you're going to get a huge gap up on the dies or a huge gap down. It just doesn't happen very often. It does gap up and it does gap down, but it's not like what happened in Apple a couple of days. So it's kind of a little bit safer. It's also a good way to kind of be able to trade a broad-based index. Edgar asked, does it work on futures? You can, yeah, absolutely. We have 182 exchanges that we cover with our Reuters data. So that's stocks and futures and that kind of stuff. Now, does this system specifically work on cattle? I'm not going to answer that. What I would encourage you to do is actually play with it. That's the nice thing about it is you can. It's one of the things about trading is that you should treat it like a business. And you can totally go in and see what your drawdowns and your things are going to look like before you start trading. That doesn't mean it always is going to stay the same, but it does give you a good idea of what to expect, which I would say is a very good advantage. Jamie says, does it work with options? We do have options data in there. Most people are going to use option data as kind of, let's say that we got a long signal of some sort. They're going to basically be looking for a directional approach choosing the meta stock and then saying, okay, well, I think it's going to go up, so I'm going to buy this particular option. matching that strategy. That's the most effective way to use it, because you can pull an option chart into Metastock and you can do analysis on it, but they just don't trade with kind of the same veracity as the underlying instrument. So usually the option traders that we have, and it's a huge percentage of our database. I mean, we, as part of that survey I mentioned, you say, okay, 60% are futures, 40% are options, or 60% are stocks, 40% are option traders. But that's a little misleading because that's 100%, but they can choose multiple instruments. Like the total is like 250, but a huge percentage of our database is trading stocks and options. All right, that's the end of the questions as I see them. I want to make sure that I say thanks for coming in today. I appreciate your time. I hope that's valuable for you. I hope, if anything, my big goal was to get you to try the program for 3 months. If you do that, you're going to like it. Most of the time, people keep it. Try it out. Give it a shot. If you like it, you're going to love it.